Good morning, everyone. It's 9 a.m. live from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live, and here is your morning rundown. Well, it's crunch time. With just 3 days to go, avoiding a government shutdown is looking less and less likely. Late yesterday, the Senate unveiled a bipartisan measure to keep the government open, but there's no guarantee it'll make it to the House floor.
Plus, you've been served. Amazon facing a landmark antitrust lawsuit from the FTC and 17 U.S. states. Now, the behemoth online retailer is accused of running an illegal monopoly in the e-commerce economy. Amazon is the latest tech giant to fall in the government's crosshairs. Google and Meta both currently fighting antitrust suits of their own.
And it's back to work in Hollywood. The writers' strike is over, with union leaders finalizing a new deal with studios. Among the wins, significant protections against the use of AI and new residuals around streaming viewership. And now in play, the spotlight solely on striking actors as they look to land a deal of their own.
Well, today's morning driver, a downbeat tone from retailers. Now, the rise in retail crime rate is creating some big problems for the industry. Target closing 9 stores over retail thefts. The company saying in a statement, quote, "Despite our efforts, unfortunately, we continue to face fundamental challenges to operating these stores safely and successfully." Even Costco executives saying on its latest earnings call last night that it is not seeing a, quote, "dramatic pickup in thefts," which means that they are seeing some form of theft pickup. But this is all part of a bigger issue of retail theft. Now, according to the National Retail Federation, the loss of items to retail theft, organized crime, damage, and vendor fraud reached $112 billion for the industry last year. That cost was up nearly 20% from 2021, when the retail shrink accounted for almost $94 billion in losses. And Brad, we talk about the fact that the deteriorating consumer right now, the fact that consumers are being forced to make choices, pull back some of their spending. That's obviously a huge concern here and might clearly be playing into the rise that we're seeing in retail theft. But it's also just a massive headwind here for the consumer discretionary sector, for so many consumer-facing brands now facing just another challenge at this point. Clearly something that we're keeping an eye on and something that Wall Street's closely watching as well.
Just one data point to add on top of this here: consumer confidence. When you think about the broader kind of outlay for consumers right now and what perhaps is drawing some of the larger activity here, especially ahead of a recession, consumer fears of an impending recession also ticking back up, consisting with short and shallow economic contraction anticipated for the first half of 2024, that coming from the Consumer Confidence Survey. And so we'll continue to watch how this all gets factored in with the overall consumer outlay right now. Also, let's talk Costco. Costco shares extending their losses in pre-market trading after the company reported its 4th fiscal quarter earnings Tuesday after the bell. The wholesale retailer beat analyst expectations on its top and bottom line, and comparable sales held steady even as gas prices surged. Investors, however, don't seem too pleased. Joining us now to break down why is Yahoo Finance reporter Brooke DePalma. Hey, Brooke.
Good morning, Brad. That's right. Costco beat on both the top and bottom line, but clearly Wall Street a bit spooked here at some of the key points that were mentioned in the call. Those 3 points include, let's kick it off with that same-store sales myths. Same-store sales came in slightly higher than anticipated, up 1.1% compared to the estimates of 1.87%. Now, excluding gas and foreign exchange, sales jumped 3.8%. That also was slightly below expectations of 3.92%. Now, what drove that same-store sales miss is the average ticket is still down 3.9% worldwide. And here in the U.S., that average ticket is down 4.5% from a year ago. Now, what we're seeing that's driving that ticket lower is weakness in bigger ticket discretionary items still holding on, as well as gas price deflation. JP Morgan out with a note this morning emphasizing that ticket growth has not been positive for Costco since 2022. And moving right along, those higher wage expenses, Citi saying in a note today that Costco is still committed to investing in associate wages and made an unplanned investment in starting salaries for some new employees this week, which is off their typical cadence of every March. Now, when asked on the call of how exactly wages compare to its competition, when you think about Walmart that recently announced a change in their wage approach, the Costco said that ultimately the pressure comes from ourselves. They said that they provide the best hourly wage packet out there. package out there with wages, benefits, and contributions. They also noted that their average U.S. employee makes about $26 an hour in the high 25s, and that's on top of what they say is a very rich health plan. And once again, you know, what we've all been waiting to hear on both Main Street and Wall Street is, will they raise those membership fees? Well, not yet. Membership fees is a key revenue stream for the wholesale retailer. We saw it come in at $1.51 billion, higher than Wall Street expectations of $1.46 billion. Paid household members is also up 7.9%. But on the call, CFO Richard Galanti saying, quote, "It's a question of when, not if. You'll see it happen at some point. We can't really tell you if it's in our plans or not. We feel good, say, about all the attributions of member loyalty and member growth." And yesterday afternoon, following the results, Yahoo Finance spoke to a CFRA analyst. He said that he expects Costco to raise membership fees by the end of this year. He expects that range will be about a $5 to $10 jump in what they currently have in both Costco Gold Star membership, which is now at $60 per year, and executive membership, which now sits at $120 per year. So not if, but when. We'll keep watching.
We certainly will. All right, Brooke, thanks so much for that. Let's stick with the retail sector and with Costco, because Costco, like other retailers, reporting weakness in those bigger ticket discretionary spending in its quarterly results. This coming after the U.S. Consumer Confidence Index reported a 4-month low, falling to a 4-month low for September. Joining us now with a little bit more about where the state of the consumer stands, we want to bring in Sucharita Kadali, Forrester Research retail analyst. Sucharita, it's great to see you here. So let's start with Costco results, because they had strong grocery sales, but weaker trends in some of those discretionary items. What does this tell us just about the state of the consumer at this point, heading into that very important holiday season?
Yeah, well, I mean, it's a pretty consistent story through all of retail. You have the grocers doing particularly well, in large part because these are the items that food in general, food both at home and away from home, has done incredibly well. In the last couple of years, it's been one of the beneficiaries in spite of waning consumer confidence and inflation numbers. So that's not surprising. The discretionary piece is also not surprising. It's the same story that we heard with Target. Walmart said the same thing in its last earnings call. And you see it in the overall consumer spend numbers that the census releases on a monthly basis, which is categories ranging from apparel to electronics, which are absolutely categories that Costco carries, which just haven't done as well. Home as well is one that's particularly soft in the last year. And Costco, as far as discretionary is concerned, has historically sold a lot of things like fire pits and patio furniture. So there's no doubt that those are categories that are challenged. And you're not seeing the strength even at Costco in those sectors.
The expectations index, as we kind of look at some of the conference board data that had come out, showed that consumer short-term outlook for income, business, labor markets, it declined, and expectations falling below 80, a level that historically signals a recession in the next year. If we were to see that, how would that dovetail into the number of consumers that are either signing up as members in Costco or leaning into some of the broader kind of buying in bulk patterns of spending?
Yeah, what is important about Costco's business is that it does tend to be fairly recession-proof, similar to other mass merchants like Walmart, in large part because when a consumer may have lower expectations for the future, they're going to fly to value. And Costco absolutely offers that. We've known that historically, their profit, for the most part, their net income, is very correlated to their membership fees. They are not really making that much money off of the sale of the physical goods themselves. And that very much is about passing value on to shoppers. It is very much about providing the best value and the best product assortment that you can for the consumer. I mean, Costco has been incredibly well managed as a company pretty much since its inception. I mean, 10 years ago, it was a $100 billion retailer. Now it's $200 billion. I know that its stock today may be taking a mild hit, but when you also step back and look at its performance over time, its stock price is at nearly its high its highest was, I think, last spring in 2022. It's comping that, and it is very comparable to the overall Nasdaq index. So it's actually overall, when you step back and look at the macro, and you look back at the bigger picture, it's actually doing very, very well. It's held up in spite of some of these issues related to consumer confidence and the fact that people are pulling back from discretionary.
Well, Sucharita, speaking of the bigger picture, let's talk about retail theft, because that certainly has been a theme this past earnings season. It's certainly been a theme now for a couple of quarters. When it comes to what we heard from Costco, or really what we heard from Target yesterday, the fact that Target is closing 9 of its stores, citing rising retail crime. How big of a challenge is this for retailers? And I guess, are certain retailers, from your perspective, dealing with it better or getting a better handle on this challenge than others?
Well, Costco is a little bit different because there's usually a human manning the front of the store, manning the exit. That just enables you to just more quickly call security or call the police if you need to. So it's less likely that they're going to be victimized in the same way that a Walgreens or a CVS would be, where there is maybe one person working the entire store and they're often behind the cash register and not seeing what's happening. So Costco is a bit insulated from some of this retail theft. The issues with these other retailers, though, is there's a larger factor with respect to just retail crime in general. When you're looking at crime syndicates, historically, the retail theft was often with credit card theft, or it was about doing things in other manners. And the issue is that after EMV was introduced into credit cards, it made credit card theft a lot more difficult. And you couldn't just steal a number and be able to buy things in massive quantities. So what we have ended up seeing is, well, what's the weakest point within the retail ecosystem? At this point, it is literally smash and grab, because a lot of these stores, due to whatever reasons, like higher labor costs, trying to cut costs, they just don't have people in their stores. And if you don't have people in the stores, and law enforcement is not going to back up the store associates at the moment of that theft, because they're not there, and the store associate certainly is not empowered to do anything, you're going to have that being the weakest link. And that's the reason that you have the theft that we are seeing in retail stores. And it's leading to a terrible shopper experience. I mean, you walk into a lot of these stores in urban areas now, and you can't even buy anything. You have to call a store associate, and there's still that single store associate that you have to sit and wait 10 minutes for. It really begs the question of, what's going to happen.
Sucharita, just quickly while we have you, we only got about 30 seconds here, but help us preview Nike here, a company where there's been kind of heavy promotional activity in the athleisure or footwear and apparel landscape. What are you anticipating there?
Well, the numbers have been soft this year, and that's not a good thing. But again, looking at the big picture, Nike is much better now than it was pre-pandemic. The demand for its core products is still strong. But the big question is going to be whether or not they brought those inventory levels down, and if they can offset some of the challenges in China.
Sucharita Kodali, Forrester Research Retail Analyst. Sucharita, always a pleasure to get some time with you. Thanks for kicking off the day with us.
Thank you.
Switching gears here, but staying with retail, Amazon is facing scrutiny after the FTC and 17 states sued the tech giant, saying it illegally blocks competitors in the e-commerce space by pushing consumers towards its own services. But our next guest says that this move isn't exactly surprising. Tom Forte, who is the D.A. Davidson Managing Director, Senior Research Analyst, joins us now. Tom, why isn't it surprising from your perspective?
Sure. So I've been following Amazon since the beginning. I've published 26 white papers on the convergence of tech and retail, 3 specifically on what could slow Amazon, including antitrust and regulation. And we expected this lawsuit by the FTC on antitrust for Amazon. Now, whether or not the lawsuit will be successful, ultimately, whether or not it'll lead to breaking up the company, things of that nature we're still monitoring, but this was expected.
Tom, what do you think the likelihood is? Do you think that this could potentially result in a breakup? And what does that then mean for Amazon?
So to me, the guaranteed is that this is going to be multiple years of distraction for the company. When you look at other antitrust lawsuits, IBM, AT&T, in some instances, those lasted more than a decade. The good news is that we see Amazon as having the ability to navigate the distraction, as evidenced by how it handled the debate over online sales tax that was ultimately decided by the Supreme Court. Do I think it's going to end up in a breakup of the company? At this point in time, no. From a stock standpoint, though, I think the good news for investors is you can make an argument that the sum of the parts are worth more than the whole. If it was broken into a marketplace, a first-party e-commerce company, and cloud computing company, there actually could be upside for shareholders.
Is that what shareholders want? Do they want Amazon broken up, Tom?
Some shareholders may want that as a way to unlock the value of the cloud computing business. But I think generally speaking, what shareholders want is for the company to continue to do what it does well, which is find opportunities to serve the end user, either the customer or the business. I think the challenge for the government as it pertains to the antitrust case here is how are they going to convince a judge that Amazon's doing ultimate harm to a consumer? You can argue that maybe they're doing harm to some of the sellers on their platform, but generally speaking, Amazon's trying to lower prices to consumer, give consumer the opportunity to buy more merchandise. I think that's going to be a tough hurdle for the government.
So, Tom, we're looking at the stock yesterday, at least closing off about 4% on the heels of this news. What should investors then do if we're not too worried maybe about what this could potentially mean for Amazon? Should they be using pullbacks like yesterday to buy?
They should. And then by other way of comparison, Google stock has materially outperformed since they were first sued. They're currently engaged in a court battle right now. Meta Platforms, for the most part, has performed in line with the Nasdaq since they were sued for antitrust. So other reasons why investors could feel confident about taking advantage of a pullback on an important situation, but one that may not be as negative for the stock as the headline would suggest.
What other tech companies could some of the allegations or accusations from the FTC that were brought forth towards Amazon also impact?
The one that I'm concerned about is Apple. And my concern for Apple is that they could get hit indirectly to the extent that we're finding out that Google's paying them, billions of dollars for placement of their search within Apple's iOS operating system. And then to the extent that there's concern that Apple is employing anti-competitive practices with its 30% fee it charges for app sellers on its platform. Now, indirectly, I think that Wayfair, Overstock, Etsy, other e-commerce players may benefit from, Amazon potentially being cut into pieces or things of that nature, or Amazon potentially being distracted. But again, I think Amazon's good at dealing with distraction. But those may be the beneficiaries of what's going on.
And then just lastly, Tom, while we've got you, when you think about some of the broader calls for how tech might fare, not just during the fourth quarter, but going into 2024, especially if we are due to see a reset of some of the expectations around where AI is actually going to matriculate into the bottom lines of businesses, what does that spell out even for some of the Magnificent Seven out there who have been on an investing spree?
Yes, I love that you're hinting that there's a lot of hype and maybe not a lot of near-term sales from AI. So my concern is the higher for longer interest rates could dampen valuation. So you could have potentially a double whammy to the extent you have lower expectations for next year and lower, rates for stock on valuation, lower multiples. That could be a problem and one that we're continuing to monitor.
All right, Tom Forte, always great to have you and get your perspective. D.A. Davidson, Managing Director and Senior Research Analyst. Thanks.
Thank you.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance. Now, the U.S. consumer may be showing signs of slowing down, but does that mean they're pulling back on their favorite alcoholic drink? Let's dive into the business of alcohol, notably whiskey. Suntory CEO Tak Nianami joins us now. Tak, good to see you. It has been a while. Now, of course, Suntory, very much a global business, playing in many big markets. Let's start on the U.S. here. We've been talking all morning long about a consumer spending slowdown, more cautious consumers when it comes to consumer confidence. How are you seeing the U.S. consumer look through the prism of your business?
I think we've been seeing the trade down from ultra premium to premium and the premium to standard. I think consumer confidence has been declining. But we are responding to that change because we have the wide range of American whiskeys, tequila, Japanese whiskey, and so forth. But we had the strategy, and all the industry players had the strategy called the premiumization. I think that is a right strategy still, because quality, assurance is so important, and our strength is always pursue quality to exceed our consumers' expectation. So having said that, we have to understand the current consumer confidence, which is declining, but is that long-term or short-term, mid-term, which we don't know yet.
How are you seeing the consumer, let's just stay in the U.S. here, for those really higher priced Japanese whiskeys that you sell? So you're maybe seeing some weakness in those mid-tier brands, but those ultra blends that you put out, what are you seeing there?
Japanese whiskey, like ours, is still attracting consumers. The reason behind is, I'm afraid to say, but we can't supply enough. So still demand is much higher than our supply, such as Yamazaki Hibiki, because of the strict policy not to compromise the quality of our whiskey. So we can't supply enough. So in that sense, still our whiskeys like Yamazaki Hibiki are chased by consumers. My mission is to apologize to consumers.
Is the business of tequila still on fire? And as someone who has been operating in this business for many years like you, help us understand why tequila is so in focus and so in favor with consumers.
I think tequila is catching new customers in states. And it's been attracting especially younger generation, such as millennials and Gen Z, mostly millennials. And those young people don't drink a lot, but the premium. Having said that, the trade down of tequila has been happening too, from ultra premium to premium. And we have Hornitos, which is very much a fit with the current change. And having said that, another factor is that the price of agave has been declining. So I think it's a good sign for us to be able to enjoy more profits. But again, we have to take a look at the trend of the consumers, younger consumers. They want to stay with the premium or toward the standard. I believe they will stay at the premium, but not ultra premium.
So you mentioned some weakness here in the U.S. and in certain areas. Are you seeing that in emerging markets like China?
Yes. China has been shifting toward the single malt whiskey from their local baijiu. This trend has been accelerating so much, though China is more or less shutting down the kind of exposure to the imported spirits. But the general trend of young generation in China wants to drink a single malt whiskey, and including to some extent very, very quality blended Scotch whiskey as well, and Japanese whiskey.
You mentioned some investments, or the product, what you make, continues to be in short supply. How are you investing to ultimately increase that supply? And then, I'm really just fascinated by your business. So, Warren Buffett earlier this year started making a lot of investments in Japan. Talk to us what he might be seeing in that Japanese economy. Why are you making those investments, and why is an investor like a Warren Buffett making those investments in Japan?
First of all, I think the current administration wants to bring more investment from abroad, such as easing the grip of the older regulation, not to mobilize labor. Now people started to change jobs. Second, higher wages than before, which motivates people to think something new. So that means we have more startups than before. And even big corporations started to invest to Japan. The reason behind is mostly perhaps the fluctuation of Japanese yen versus dollar. We better invest to Japan. And we have lots of inbound visitors. So there are lots of investment frontiers now in Japan because one thing, we didn't do a lot of things. So there's a huge room for us to improve, for us to do something new because we didn't do, such as even digitalization. We are lagged behind from the United States and perhaps Europe and China. But we started to change the landscape of Japan from deflation to moderate inflation.
Tak, lastly, before we let you go, I think a lot of investors on our platform only know you as leading Suntory on this global basis and driving a very large transformation of your company in Japan and around the world. How have you protected that very interesting culture of a Suntory, and how do you ultimately at some point hand that off to the next generation?
First and foremost is we should not compromise our quality story, and plus try to let the drinkers, consumers, fans understand our culture, to live with nature. That's a huge asset of Suntory as well as Japan. So that is our differentiation.
All right, we'll leave it there. Suntory CEO Tak Niyanami, always a pleasure to get some time with you. Full disclosure, I've had a lot of your whiskeys before, so look forward to staying in touch.
Thank you very much.
All right, guys, back to you over at the Nasdaq.
All right, and enjoyed them thoroughly. Brian Sozzi, thanks.
And share some.
Yeah, exactly. All right, everyone, we're inching closer to the opening bell on Wall Street here. Let's take a quick check of the markets here, sponsored by Tasty Trade. As we're taking a look at the futures this morning, one thing that investors are going to be keeping a close eye on, especially as we move forward throughout the rest of the week, it's been some retail earnings. We've got a few points of economic data coming out, but futures right now pointing higher across the board, perhaps trying to reverse some of those consecutive down days that we had seen. Here's the opening bell. All right, and that was the opening bell here on this Wednesday, hump day, as some might call it, whatever neck of the woods you find yourself in. Let's do a quick check of the market, sponsored by Tasty Trade here. We are mixed right now. The Dow, the S&P 500, they open slightly positive, but the Nasdaq, you're seeing that open lower. That's down by about, well, we're going to wait for things to calibrate here. It usually just takes a hot second, but as we see things calibrate, you're seeing all major averages in positive territory. For the Dow, the S&P 500, and the Nasdaq, fractional gains across the board. Let's get on over to Yahoo Finance's own Jared Blickery to see what else is taking place early in the tape today, Jared.
Hey, Brad, we got WTI crude oil shooting higher. Not surprisingly, XLE, that is the energy sector representing large cap energy. That is in the forefront, up over 1%, followed by real estate, industrials, and then tech. I would say this is just a bounce back at this stage. You can see a couple of defensive sectors in the red. Doesn't mean much, but I'll go to the S&P 500 in a second. First, I want to show what the Nasdaq 100 looks like today. NVIDIA is a standout in the center here, up over 1 1/3%, followed by some other chip names that are doing well here. Not a lot of standouts, but let me just put the 2-day price action in, and you can see we are just clawing back some of those losses, deep losses, for instance, in Amazon that we saw yesterday. Amazon down 3.7%, was down quite a bit more. We'll just check out the 3-day as well, since we happen to be in the third day of the week, and you can see kind of a mixed board there. But I did say that we were going to check out the S&P 500. I want to show you a couple of patterns that are playing out right here. We are breaking down over the last few sessions. We have this head and shoulders pattern here. It would be normal to test the neckline and then try to go down, and we'll have to see. I see this playing out even stronger in the Russell 2000. Here's that head and shoulder, more traditional, that we're looking at right now. And here's what that might look like if we came back up and tested that breakdown area and then headed lower. We'll have to see. But the but the Russell 2000 essentially in a very large trading range over the last few years. Let's get back to some heat maps and chart what's happening today. Some of the sectors that were really getting pounded yesterday, especially value. Energy's up. I mentioned the crude oil surging higher. ExxonMobil taking advantage of that. Chevron also up more than 1%. Taking a look at China stocks, which have somewhat decoupled over the last couple of years with everything else. Those are, you're seeing a mixed board right here, but more green than red. And if we check in on disruption, this is kind of a fringier part of the market. Aside from Tesla, let's do this on an equal weight basis. Aside from Tesla, looking pretty good there. One of the things I like to look at when I'm trying to gauge market sentiment is when we see money coming into some of the side pockets of the market, the fringier places like cannabis up here, crypto, disruption, and then you see home builders and solar. All of that means that some of the sectors that got beat down yesterday really getting a little bit of love today. But I think this rally remains to be proved. We'll have to see what happens into the close. And having said that, we still have some negative seasonality headwinds over the next week. This is supposed to be the worst week of the year, and seasonality plays. What we think is going to happen based on history, that's been working very well this year, guys.
All right, Jared, thanks so much for that. We'll see what happens with the rest of this week as we close out what has been a pretty down a month here for stocks. All right, let's take a look at some of the individual movers of this morning. First up, checking in on Rivian. That stock trading to the downside, off just about 0.1%, but the electric truck maker saw investment banker Baird reiterate its outperform call on the stock today, saying that the stock was a bullish fresh pick. Now, this coming as Rivian is set to report its delivery numbers prior to its earnings release later on this fall. And Brad, when you take a look at this call here from Baird and exactly what they're talking about, they're saying that they expect Q3 deliveries to be a near-term catalyst for the stock. They also think that Rivian's going to benefit from improving supply chain, although that does remain a little bit of an issue, at least in the near term. But there are some signs that the supply chain is improving. And then also the use of in-house components that could potentially give Rivian an edge.
Yeah, it's been an interesting year as we've been tracking Rivian shares as well here. And I'll get back to the note in a hot second because some of it comes on the back of some of the delivery numbers that were also put up. Year to date, Rivian performing well. It's up by about 28%. You think about the deliveries, and we've gotten a few updates in terms of the EV front on deliveries this week. Fisker, we heard from them earlier this week. For Rivian, and particularly here, the Baird analyst Ben Callow talking about the EV expectations for delivery in Q3. Consensus right now, delivery estimate for Rivian, about 14,000 units. And for the record here, also, we should note that kind of previous to this, it was at about 15,000 units. So all of this said, Ben saying here that concerns regarding third-party reports of weakening demand have led to recent weakness in the stock. They believe underlying demand remains strong with production improving here. So perhaps some of that improved production, something that we can extrapolate from at least these most recent two upgrades to the estimates, both from the Rivian case here, but also from the Fisker case that we got earlier this week that the company themselves reported. And we'll see if any other EV players also emerge as some of the upgrades that come forward, at least on the back of some of the delivery anticipations that they might be able to deliver upon here as well. Well, we got to switch gears and talk about Barbie. You know, it's my favorite. Barbie hype may be fading, though. Mattel, however, keeping on top of trends in the toy company's shares. You're seeing them up by about 4% on the day. This comes after Morgan Stanley called the stock a top pick and gave it an overweight rating here. Mattel also announced that it would be releasing a new AI version of the guessing game Pictionary. I wish there was an Allen Iverson version of this, but it's not. It's artificial intelligence. It would have been good. The first board game that will integrate AI technology into how gamers can play here. It's been all Barbie this year, but Mattel also, of course, across their entire gaming suite, needing to make sure that they're keeping up with the latest technology.
Yeah, certainly. I mean, it's just been incredible when you take into account what has happened with Mattel over the last 12, 18 months. When we first started talking about the Barbie movie, talking about what it could potentially mean for the business and seeing how much of a success Barbie has been and what that could mean here for the future of Mattel. When you talk about the focus here that Morgan Stanley expects, and even what Mattel executives have talked about, just about leveraging and monetizing their vast IP extensions here. When you talk about the IP extensions, reports and talks of 14 more movies that are in development with Hot Wheels. You have Matchbox Cars, Major Matt Mason movie. The list goes on and on and on. And this is a real catalyst here for the company going forward, is something that Wall Street has really focused on over the last several months in the wake of the success of Barbie, and what this could do for a company that you would think in a time like this would be struggling a lot more than it is, given the pullback that we're seeing in consumer discretionary spending. Right. But Mattel, its position there, the fact that it was able to make Barbie relevant once again and appeal to multiple generations, I think also just shows what the potential future could look like here for Mattel when we talk about some of the other movies that could be on the docket.
It also makes it all the more important for them to see a resolution, not only on the writer's strike, as we got that coming forward, but then additionally on the actor's strike too, because the delay of either of those movies could really look at a scenario where Mattel is also going to have to push out when it can recognize that revenue, especially considering how they were able to create so much fanfare around the Barbie movie and so many different shoppable moments along the way. Heck, I bought our esteemed Ken, I Am Kenuff mug, so he's got that prominently placed. I think it's on his desk. I hope it's still there.
We got to check it out after the show.
Slide in our Slack DMs.
I know. Well, there's a couple of people on the production teams who have jumped in on the Barbie stuff. Yeah. So I mean, it just speaks to the power of it, and everyone was excited to get it.
Yeah.
All right. We'll see. All right. Well, let's talk about our last mover today, and that's ChargePoint. Shares of the EV charging stock on the move, up 6% right now after the open. UBS initiating coverage on the stock, giving the company a buy rating, a $9 price target. The firm saying that ChargePoint could create an attractive risk reward given its recent stock performance. And we know the stock hasn't done a heck of a lot when you pull up some of those longer term charts here. When you take a look at what the stock has done year to date, certainly has not been a standout by any means. When you take a look at the fact that obviously there is a need for more chargers within this space, although reports of Tesla, or the confirmations, I should say, of Tesla really pushing its supercharging network, partnering with so many automakers out there, what exactly that would mean for a company like ChargePoint. ChargePoint, though, saying that there is such a great need for chargers throughout North America and really globally as we talk about this massive transition to EVs, that the company is still well placed within that industry, talking about potential growth and future growth. That is at least what the analyst is saying here in terms of their bullish outlook. They're saying that the deep customer base and the clear path to break even EBITDA for the fourth quarter of fiscal 2025 is going to help propel shares here.
Yeah, a little bit of a crash course in chargers this morning for anybody watching, especially if you're kind of looking at the share price action that we were just breaking down for you a moment ago, pairing that with what the note is saying that the company has 33,000 charging stations. UBS noting this. Firm sees L2 charging ports, such as the HomeFlex port, eventually accounting for over 90% of the installed base in 2030, up from 80% roughly right now. And so what the heck is an L2 charger? Little crash course here for you. It's basically like a gas pump in your garage, but a smart appliance that charges your vehicle. This, according to Evo Charge, and an added convenience. Not only is a level 2 charger ready when you need it to be, you can save on electricity a little bit more during the lower rate time. So some of the perhaps energy recovery perhaps that is baked into that too. All that said, you can essentially have an average charge time for about 3 to 8 hours versus the level 1, which is about 11 to 20 hours as well there.
Wow, that was a crash course.
I try.
Much more educated on chargers now.
You know, charging information, stock price movements, all the fun smiles.
Get it all right here on Yahoo Finance.
Plus all your markets action straight ahead, live from the Nasdaq market site. Stay tuned.
The clock is ticking for Congress to reach a deal before it's set to run out of money. And with just 3 days until the deadline, pressure is mounting on House Speaker Kevin McCarthy after the Senate voted to advance a bipartisan stopgap bill in a bid to avert a shutdown. Now, the legislation would extend funding to 2023 levels through mid-November and also provide billions for Ukraine and disaster relief. Here to tell us more, we want to bring in Maya McGinnis, president of the Committee for a Responsible Federal Budget. Maya, it's good to see you here. So let's start just where things stand right now down in D.C. We had this stopgap bill here from the Senate. Of course, the pressure mounting on House Speaker Kevin McCarthy. Is there any way you think that we're going to be able to avoid a government shutdown?
Well, I do think it's possible, but I'm probably the most optimistic person there is when it's putting odds on this. In fact, we have the very, very, very unscientific poll of budget experts, and they think the chances of a shutdown are about 88%. So pretty much a sure thing. I am more optimistic than that, and I actually thought last night was good news that the speaker was able to move forward on some of these things. There seemed to be a little bit of give, but the bottom line is the clock is ticking. There's very little time to get this done. And the variety of parties, it's not just two parties who are thinking about this, but the variety of groups of interests are very far apart in terms of how much they're willing to give. So it is more likely we will have a shutdown than not, though, again, I think we could find a way to eke our way out of this. But even if we don't have a shutdown now, the question is, how will we resolve the big outstanding issues of how you fund the government? There are very different senses of what level the government should be funded at. And if we get a bridge of a couple weeks or a couple months, those outstanding tensions will still remain. So we might be revisiting this again in the future, even if we avoid it now.
What continue to be the largest gaps or the largest disagreements from your evaluation?
Right. So remember, around the debt ceiling, where we were talking about an even worse outcome, which would have been defaulting if we couldn't resolve the issue, there was a bill called the Fiscal Responsibility Act that was passed. In that bill, they set discretionary spending levels for the coming 2 fiscal years. The problem we have right now, and we know what those numbers are, we know what the level should be set at, it was complicated by that there were a number of side deals that actually made those numbers larger than they appeared to be. And so the problem we have right now is that the House is saying, wait, that's higher than we wanted. And I shouldn't say the whole House. A small group of more conservative Republicans are saying that's significantly higher than we want. And we look at those as caps, but we want to come in below them. Lesser understood is that the Senate, that has been working to pass their appropriations bills, has also said, actually, we don't like these caps. We're going to spend more than is in them. So they've actually broken through them and are putting about $14 billion more into their bills than has been approved. So the Senate wants to spend more. The House wants to spend a lot less. The only way to really go forward is for them to honor the deal and spend at the actual spending level caps. And then for them to work out the differences, because this is going to happen again for the next fiscal year too. They need to be more committed to the agreement they've already made. And then they need to get to the real problem of this, which is the Fiscal Responsibility Act put in place savings of $1 to $2 trillion. But that's not enough to address the big fiscal problems the country faces. And so as soon as they can get through this, nightmare of a soap opera, they need to turn to the real issue, which is how you deal with our fiscally unsustainable situation. What might help us get through that?
And Maya, you pointed out there, obviously, the very importance between a government shutdown and a government default. But when we focus on the uncertainty that a government shutdown could bring, or maybe some of the ripple effects that investors, that Wall Street, that Main Street needs to be aware of, how serious are the potential implications of the government shutdown?
Yeah, that's been the story of the past couple of weeks, where people are saying, how would this affect real people? What happens? And in some ways, I find that it's unsatisfying because it's not nearly as dramatic as people expect, because most of the government's funded not through these appropriations, but through mandatory spending. Almost 3/4 of the budget is kind of automatic and will get paid. And of this discretionary spending, much of it is declared to be essential, which means things still go on. So the Department of Defense will be operating most of those parts, the things that you think of as defense policy will be. Many of the other things will be. The biggest example is always, and this stinks if you're going to a national park, but national parks may well shut down. But that doesn't have broad effects throughout the economy. However, if the shutdown lasts, it does start to have ripple effects. I was meeting with a group from Arizona yesterday, and they said, you better believe that affects our economy. Same with Utah. So it starts to creep into the rest of the economy, not directly, but indirectly. However, most of the estimates of the loss to the economy of shutdowns show that it takes a hit in the first quarter. You make up much of that in the second quarter. I think the biggest problem with shutdown, we advertise to our rivals around the world that we are unable to govern ourselves, and that shows a huge weakness on the global stage, which we should not we should not be having, and we should not be showing at a time when there's so many frictions around the world.
All right, Maya McGinnis, president of the Committee for a Responsible Federal Budget. Thanks so much for joining us and helping us break down what's in the mix here, what's in the negotiations, and we will see if we're able to avoid it. Thanks so much for the time.
Thanks.
All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
There's always hope, and I don't believe in a no-win scenario. We understand what a shutdown means to the government, to the American people. I certainly do not want that, and so we also have some other Republicans on the more moderate side that certainly don't want that. It's an interesting situation. I hope that during this weekend we can come to some solution and come back and work it through.
The odds of a shutdown are increasing. Modern, mature governments should not be shutting down. It's certainly a crazy impact, probably an impact on the markets, an impact on the economy, an impact on all of the government operations essential to keep society humming along. And right now, the House is talking about going out for 5 days and coming back next Tuesday. And at that point, they would just have till midnight Saturday to work out a continuing resolution. So things are looking worse than they did a couple days ago.
The real problem right now is Speaker McCarthy continues to be really led around by a very far-right extreme contingent in his caucus. Look, at the end of the day, if Speaker McCarthy agrees to put up for a vote in the House the kind of bipartisan proposals that we're sending from the Senate, I'm confident that they would pass. The question is whether he will put the country before his own interests and move forward in that way.
Welcome back. We are live from the Nasdaq market site. You're watching Yahoo Finance. 7 Republican 2024 presidential hopefuls set to take the stage tonight. That's down one person from the last debate after former Arkansas Governor Asa Hutchinson failed to qualify. Former President Trump, currently the front runner for the party's nomination, is also skipping the event. Here with what's worth keeping on your radar tonight at the debate is Yahoo Finance's Rick Newman. Hey, Rick.
Hey, guys. So of the people who did participate in the last debate, Nikki Haley, many analysts think did best, and she has actually risen in the polls. In a couple of polls, she's actually now number 2 way behind Donald Trump, but she has jumped over Ron DeSantis to lead number 2. So one thing I'm looking for is if some of the other candidates in this debate will actually start attacking Nikki Haley, trying to bring her down, which would indicate that would actually be a good thing for her. It would indicate she kind of has front runner status among those who are at the debate, not including Trump, of course. Vivek Ramaswamy, he made a big splash in the first debate because nobody ever heard of him, and he came out as this brash upstart who kind of wouldn't shut up. So I think we're going to find out, does he sort of command the microphone as much as he did the first time around? And I'll always be watching for whether any of these candidates actually change their approach to former President Donald Trump. Really, the only one who has really attacked Trump has been Chris Christie. We'll see if anybody else actually goes after Trump. I'm not expecting it. But we do have this interesting development that Trump has now been found liable for fraud in this civil suit in New York State. So that basically relates to him undervaluing his properties by hundreds of millions of dollars over many years, and he has to pay a $250 million fine if that holds. So we'll see if any of the candidates mention that, along with the 4 criminal cases involving 91 criminal charges against former President Trump.
Yeah, Rick, you just mentioned that latest ruling that we got from the New York judge about fraud and talking about the valuing of his assets. When you talk about how this could potentially complicate his campaign, just another distraction here for President Trump, do you think it's really going to move the needle at all? Because his supporters up until this point have really brushed off all of his legal issues.
Well, it's an expensive distraction if it holds. In addition to that $250 million fine, the judge in that case basically decertified some very important Trump businesses that are worth a lot of money to him, real estate, basically. And for anybody who's wondering what the heck is this all about, this is the culmination of all the exposés, including leaks by helped by Trump's niece, Mary Trump, to the New York Times while Trump was president, about how he got away with paying no taxes in New York State and in New York City for many years. Basically, it's a complicated story, but basically by severely undervaluing his properties and saying they were worth a lot less. And then he would go to banks and say they were worth a lot more so he could get bigger loans. Well, that turned into a civil case, and that civil case has now come to fruition. Trump will appeal that. We'll see if it holds. Will this make a difference, layering it on top of the 4 criminal cases? I doubt it. I think there are so many legal matters involving Trump that voters just know he's facing a pile of legal trouble, and they're not distinguishing among the criminal cases and the civil cases. It's a big problem for Trump. I mean, it actually threatens the viability of his business in New York State. But given everything else, I don't think that is something voters are really going to focus on.
And Trump calling it un-American, part of the ongoing plot here to damage his campaign to return to the White House. So, of course, we're going to continue to follow that. Rick, thanks.
Bye, guys.
We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning, everyone. I'm Brad Smith alongside Shauna Smith at the Nasdaq market site in New York City. You're watching Yahoo Finance Live. Hey, we're just about 30 minutes into the start of today's trading activity. Let's take a look at how things are shaping up. Stocks are rising this morning, boosted by a dip in Treasury yields, as well as a surprise 0.2% rise in new durable goods orders.
Looking at individual name, shares of UBS are slipping today on a Bloomberg report that says the U.S. Department of Justice is expanding its probe into the bank over possible compliance failures that allowed Russian clients to evade sanctions.
And we're watching Levi's, the denim retailer, popping today after TD Cowen initiated coverage of the stock with an outperform rating. The analyst saying that Levi is in, quote, early innings of a favorable denim cycle.
Ooh. And we are also watching shares of Marriott today, moving to the upside as the company is set to lay out its 3-year financial plan at an investor meeting today. Now, the hotel chain plans to add 230,000 to 270,000 net rooms over 3 years, expanding to nearly 1.8 million rooms by the end of 2025. The company also projecting global revenues per available room growth at 3 to 6% in that period. Now let's get to your market commentary of the day. Former Goldman Sachs chairman and CEO Lloyd Blankfein believes that the U.S. central bank probably will not need to keep interest rates higher for longer. He says that inflation is successfully near the high twos and you don't need 5.5% interest rates. Now, Brad, interesting timing because we heard from JP Morgan CEO Jamie Dimon saying that not necessarily expecting a 7% handle when it comes to rates, but saying that maybe this is something that investors should keep on their radar and exactly what that would potentially do to the markets and the impact here on the economy. But more so what I think is interesting is Blankfein coming out and saying this after we heard from Fed Chair Jay Powell last week and some of the more aggressive and hawkish commentary that we got from the dot plot, just signaling the fact that the Fed is expecting to need to stay higher for longer in order to finish that last mile battle against inflation.
Yeah, channeling some Jordan Belfort energy saying, hey, we're not going anywhere. We're not finished yet. But that's not what the markets wanted to hear last week, and you saw that in the equity market reaction. But in terms of what you're hearing from two very powerful names that have the propensity to move markets in Dimon earlier this week and now Blankfein as well, and given the former role that he had as CEO of Goldman, what he says still matters very much. So the quote here that kind of sticks out to me, inflation is probably within the threes. Let's say you successfully get it to the high twos, which has been among the commentary that we've heard from many economists. If you were able to get inflation down to the high twos, would the Fed be satisfied with the policy and the decisions that they've been able to enact? Now, of course, there's going to be a lot of lag to actually seeing that take place, so that's important to note here. But Blankfein also adding and saying that you don't need 5.5% interest rates at that point when inflation is relatively subdued. So we will see what further activity the Fed feels like it needs to enact if we are able to indeed get to the high twos and then perhaps have a slow and steady trend down to that eventual 2%, or what type of activity that the Fed might, or the tenor that might kind of overwhelm the conversation, even if we were to get to that high two range.
Yeah, certainly. Blankfein also went on to say that this cycle could be different, and he still thinks that there's a chance that we're going to be able to avoid a recession. We know a soft landing has pretty much been the base case there for many forecasters over the last several months, but coming off some of the hawkish comments from Powell last week, there has been a bit of a reassessment just in terms of whether or not a soft landing is still possible or if a recession is almost more likely at this point. But Blankfein striking the optimistic tune, saying that he still thinks a soft landing can be done and he's confident in it. So we'll see. Only time's going to tell.
Yeah, indeed. All right.
Right.
Well, we are going to be watching that closely here and seeing how markets continue to react to the commentary from both of these individuals. Stocks, though, in recent periods and recent days have fallen as the market increasingly took on board that interest rates will stay higher for longer. The prospect of a U.S. government shutdown is also increasingly preying on investors and weighing on those nerves. So how can you best position to weather this turmoil? For more, we're joined by Jack Manley, who is the JP Morgan Asset Management Global Market Strategist here. Jack, good to have you here with us today. First and foremost, you hear comments like these from either Dimon, of course, of your own firm, and then additionally of former Goldman Sachs CEO Lloyd Blankfein. How do you kind of reposition, if at all, given kind of these contrarian takes?
So I think we have to recognize, Brad, that when it comes to gaming out the prospect of interest rates, not just this year, but next year and the year beyond, that at the end of the day, most people's views don't matter on this. Most people's opinions don't matter on this. You know, what I think about interest rates doesn't matter a whole lot. The only opinion that we really need to be paying a whole lot of attention to is the opinion of Jay Powell, right? Because he ultimately is the one that is going to be driving this move forward in interest rates. I think we take the Fed more or less at face value, and I think, frankly, there's no reason not to do that. Every single step along the way since this hiking cycle started, the Fed has been pretty true to their word. So I would not expect us to deviate meaningfully from what the dot plot is laying out. And I think if you have that frame of mind, it's a little bit easier to have a little bit of clarity on what next year or the year beyond may hold.
So, Jack, if we should be expecting this higher for longer environment, then what does that then tell us just about the probability of a recession here in 2024?
In and of itself, Shauna, I don't think higher for longer necessarily translates into a recession. I think we have seen that this economy has been remarkably resilient in the face of an extraordinary rate hiking campaign. This labor market has been extraordinarily resilient in the face of this rate hiking campaign. I do think, though, that risks are increasing. They're building when it comes to at least near-term recession probabilities because of some of those other headlines that you guys had mentioned earlier in the segment. Right? We're talking about the looming government shutdown. And yes, the Senate may have be close at least to passing a bill, but the House doesn't seem to be at all. We have the United Auto Workers strike, of course, also sort of threatening automobile production. All of these things weighing on consumer confidence, and ultimately the consumer is the engine of growth. If we aren't feeling good about current conditions, we may tighten our belts a little bit, and that could translate into a short-term slowdown.
That starts to get to the question that I was about to ask, Jack, which is how much gas is left in the resiliency tank from the information and the data that you're evaluating?
It's hard to say, you know. I mean, the consumer, I would say, has defied expectations the entire way through. So trying to say, all right, this is the real time that the consumer finally cries uncle, I wouldn't try to play that game, right? There's too much speculation on that front. I would also remind everyone that while it may not be unique to Americans, I would say that Americans do have a tendency to spend when they aren't feeling so good, right? Retail therapy is a very real phenomenon for the American consumer. So we don't necessarily have to translate lower confidence into lower sales, even though classical economics would typically suggest that. I would say that as long as there's a little bit of clarity on where rates are going, current levels of spending are somewhat sustainable. So my base case still isn't for a recession. I just have to acknowledge that the risks there have ticked up a little bit recently.
Jack, what's your assessment just of the risk of a government shutdown? Investors, we know, have largely been shrugging off this risk. Is that something that you're keeping on your radar?
So I'm not a politics guy, Shauna, but when it comes to thinking about the government shutdown, I think we all have to remember that the implications of a government shutdown are not nearly as severe as the implications of breaching the debt ceiling, of defaulting on the debt, right? These are very, very different sort of outcomes from a political perspective, from an economic perspective. So I would say that that sense of urgency that we all sort of knew was there for solving the debt ceiling crisis just a few months ago is not necessarily here for this government shutdown. It seems more likely than not, given what's going on in the House right now, that the government probably does shut down on Sunday. I don't think it's going to shut down for very long. And we know that certain impacts or certain aspects of government spending will not be impacted, like Social Security payments. But you could be looking at several million federal government employees that are no longer collecting paychecks. And again, that over the short term could have an impact on confidence, could have an impact on spending. So I am a little bit worried about the shutdown. It's not a doomsday situation like defaulting on the debt, but it is something I think to be concerned about, and we should pay attention as investors.
As you think about the longer time horizon investors out there, if you're thinking about some of the top ideas that you have for 2024 and really looking back at 2023 and continuing to kind of extrapolate or read through the lines there, what are starting to formulate or brew as your top ideas for 2024?
So for the first time in a while, Brad, and I guess it's been true for me for a few months now, I am more constructive on fixed income than I am on equities, at least over the next, say, 12 to 18 months. You are clipping a really, really healthy coupon without taking a whole lot of risk from either duration perspective or from a credit perspective. And I think investors should embrace that, especially when you consider that rates will be moving lower next year, the year after, and that duration trade could kick in and provide additional price return. But I am still constructive on the equity market longer term. I just do that in a slightly different way. I think we have to truly embrace this idea of higher for longer interest rates. And I think we have to remember that even when the Fed was calling for 100 basis points of cuts next year, as opposed to the current 50, we were never anticipating getting back down to zero on interest rates anytime soon. That means that the cost of capital is no longer free. Money actually means something in today's economy, in next year's economy. That means that businesses are going to have to be more thoughtful about how they allocate. It means that investors are going to have to be more thoughtful about how they allocate. So rather than making a style box decision within the equity market, I am tilting first and foremost towards quality assets. Growth or value doesn't matter as much to me. I'm also making the case for active management. Now is the perfect opportunity for good sector and security selection.
All right, Jack, we got to leave it there. Appreciate you taking the time. Jack Manley, JP Morgan Asset Management Global Market Strategist. Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
We're here at the Nasdaq in New York City. Let's do a quick check of the markets sponsored by TC Trading. Taking a look at where things stand right now, about 45 minutes into the trading day. You're looking at the Dow just below the flat line, off about 35 points. S&P and Nasdaq trading just above the flat line there. Not a whole heck of a lot of movement on this Wednesday morning. And taking a look at the sector action that we're seeing play out this morning following what has been certainly some pressure in the markets lately. Energy by far the leader in today's action, up just over 1.5%, followed by industrials, materials, and real estate among the leaders today.
Well, speaking of sectors here, the technology sector and the hype in AI have been pushing stocks higher throughout the first half of the year, but recently tech stocks have tumbled, leaving the S&P 500 Information Technology Index down more than 10% from its July high. Let's bring in Yahoo Finance's Jared Blickreed to give us the details on this. Hey, Jared.
Guys, tech in a correction, and a picture is worth 1,000 words. I got the Nasdaq 100 month-to-date results, and you can see the tech-heavy index, a lot of its components just really kind of mired in the red there. And if we take a look at the sector action in the S&P 500, as you were talking about, energy, really the big standout of the month, as it was all of last year. That's the only one in the green. To the downside, real estate and tech are the two worst off. And if I pull up a chart of XLK, this is a 3-month chart, you can see it is now broken below those August lows. And if I put a year-to-date on, before in the earlier hour, I was charting some of the head and shoulder patterns that we're getting. Well, we are right at the Rubicon right now with the XLK. And for that matter, let me just go to the Nasdaq Composite overall, because that is also entering a very similar pattern, but in fact, it's a little bit farther down. It's actually broken down here. So everything pointing to further downside action. And a lot of this, if you want to look, if you think about the tech sector, one of the stalwarts, one of the biggest, most important stocks there is Apple. Apple itself is breaking down. And let me just show you what's happening on a 3-month basis with some candlesticks. You can see it has now punctured those August lows, just like XLK has. So as Apple goes, tech tends to go, and that's what we're kind of seeing here. I want to close with a look at energy versus tech, because energy has been seeing a lot of love, as we've been seeing. This purple line right here, this has been trending higher. That's not surprisingly energy. This cyan line right here, this has been trending lower. That is the tech sector. So some big divergences we're going to want to see play out here. When tech finally finds its footing again, is energy going to be the new leader, or does tech regain its #1 slot, guys?
All right, Jared, thanks so much for that. Something we're going to keep an eye on. Let's talk about another headline here, and that's the Hollywood writers' strike has finally come to a close after 148 days. The WGA strike was just shy of becoming the longest-running strike in Hollywood history, falling short of the 154-day strike back in 1988. Let's bring Yahoo Finance's Akiko Fujita to give us more insight into the contract, what we know about this agreement. Akiko.
Good morning to you, Shauna. That's right. Well, this deal still needs to be ratified by members of the Writers Guild. But for the first time today, writers do have the green light to go back on the job after 5 months off the job. Now, the final deal that was reached between the WGA and the Alliance of Motion Picture and Television Producers points to a real shift here in the way that writers are now compensated in the streaming era. Specifically, writers will receive a pay increase ranging from 3.5% to 5% over the course of the 3-year contract. Members will now be eligible for residuals based on streaming views, with a 50% bonus baked in for projects viewed by 20% of a given platform subscribers, and that is over the course of the initial 90 days of release. Writers also secured protections against artificial intelligence, a key sticking point here for rewriting original materials or source material. That means studios will now be required to disclose to writers whether, in fact, source material was generated by AI. And studios will also be required to staff a minimum of 3 writer-producers for first-season shows that have a runtime of roughly 20 weeks or more. Now, while writers have a deal in hand, major production for content isn't expected to resume, largely because there are no actors to go forward on scripted content. Members of SAG-AFTRA remain on strike. If the union does not reach an agreement soon, production is likely to be pushed back even further. Now, meantime, the economic impact from this strike continues to ripple across the region, with everybody from caterers to dry cleaners, as well as restaurants, all on hold over the last 5 months. The latest numbers from the Milken Institute estimate it's already taken $5 billion from the region, guys.
And so are there portions or at least elements of what the WGA is voting for and their attempt to ratify an agreement that could also be passed through into the actor side as well, Kiko?
Well, artificial intelligence certainly a significant one. In the case of SAG-AFTRA, they are looking for protections, especially for background actors. We know them as sort of extras. That's sort of been the traditional term here. But background actors sort of arguing that they shouldn't be able to have actors scanned, only to have AI sort of generate them in the background. So that's one of many issues here. It's worth noting, though, SAG-AFTRA and the AMPTP have not met in roughly 2 months. There is no schedule, at least a meeting on the table right now. But the expectation is now that there is a WGA deal on the table, SAG-AFTRA is next in line. The hope is things could get resolved pretty quickly there. So the year is not a wash.
All right, sounds like my days of reality TV might be coming closer, creeping just a little bit closer to an end. Akiko, appreciate the breakdown here. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
There's always hope, and I don't believe in a no-win scenario. Like, we understand what a shutdown means to the government, to the American people. I certainly do not want that, and so we also have some other Republicans on the more moderate side that certainly don't want that. It's an interesting situation. I hope that during this weekend we can come to some solution and come back and work it through.
The odds of a shutdown are increasing. Modern, mature governments should not be shutting down. It's certainly a crazy impact, probably an impact on the markets, an impact on the economy, an impact on all of the government operations essential to keep society humming along. And right now, the House is talking about going out for 5 days and coming back next Tuesday. And at that point, they would just have till midnight Saturday to work out a continuing resolution. So things are looking worse than they did a couple days ago.
The real problem right now is Speaker McCarthy continues to be really led around by a very far-right extreme contingent in his caucus. Look, at the end of the day, if Speaker McCarthy agrees to put up for a vote in the House the kind of bipartisan proposals that we're sending from the Senate, I'm confident that they would pass. The question is whether he will put the country before his own interests and move forward in that way.
Welcome back, everyone. We are live from the Nasdaq in New York City. With just days to go before the government runs out of funding, the Senate has unveiled a plan to avert a shutdown. But the bill faces long odds in the House, as Speaker Kevin McCarthy struggles to negotiate a deal that will satisfy hardliners in his own party. His other option is to work with House Democrats, but doing so could position Speaker in jeopardy. Hard right members, namely Congressman Matt Gaetz, have repeatedly and previously threatened to oust McCarthy. Is there any hope to avoid a shutdown this late in the game? And how real is the threat to McCarthy's leadership? With us now, we've got Chris Lehman, who is the nation's D.C. bureau chief. Chris, good to have you here. We've been trying to get a gauge on the probability that we will either go into a shutdown or perhaps on the Rosier side, avoid a shutdown. What are you putting those odds at right now?
I would put the odds of a shutdown happening as extremely likely at this point. The deal that the Senate hammered out yesterday would be a good framework if we had a kind of sanely run GOP majority in the House. We don't. As the clips you had showed demonstrated, this hard right faction within the caucus is kind of throttling any deal out of the gate. They have, not even allowed basic spending priorities to come to a committee vote, let alone to a floor vote. As you also noted, the prospect of collaborating with Democrats who could easily pass any House budget measure is sort of a poison pill for Kevin McCarthy's speakership. And the reason for that is, in order to get the speakership, he agreed to a motion to vacate provision, which is what Matt Gaetz keeps waving in his face every time there's a prospect of any kind of agreement. So you have this kind of nihilistic wing of the Republican caucus that is simply opposed to any agreement that can be depicted as a win for Democrats. And they're prepared, evidently, to shut down the entire government to prevent that from happening. And meanwhile, Kevin McCarthy is sort of being held hostage to the Faustian bargain he made in order to become speaker. He gave all this power to the hard right in his caucus, and now they are flexing it and threatening his speakership. So McCarthy's ultimate calculation here is, do you govern in a responsible manner and keep, the basic services of government functioning and potentially surrender your speakership, or do you hang on to your speakership and own what would, by any measure, be sort of a catastrophic, self-inflicted budget crisis on the rest of the country? Sadly, everything is trending in the latter direction.
And Chris, that leads me to ask you, because certainly there have been both sides of the aisle obviously at risk here. If we do see a shutdown, just in terms of public perception and the potential backlash there, if we do see a government shutdown, does anyone win in that situation?
No, and Mitch McConnell, of all people, has come forward and said that nobody wins a shutdown. And in this case, it is worth stressing, in past shutdown fights, there has been engagement on both sides of the partisan aisle. This is a unique set of circumstances in that it's all self-inflicted on the Republican side. Democrats have, not really engaged because they're just waiting for McCarthy to get his caucus in sufficient order so that, again, basic committee votes can be cleared. It's hard to see any scenario. I mean, McCarthy right now is making kind of a last-ditch pitch to make it all about border security and claiming that, because, Biden and the Democrats won't endorse a draconian border crackdown, that they own the shutdown. I don't see that really working as an appeal to the general public. You're going to see, millions of government workers who are deemed non-essential no longer drawing a paycheck. You're going to see, profound, knock-on effects in the broader economy in the event of a shutdown. And again, it all stems from the basic inability of McCarthy to keep his caucus in line. That is very much a Republican problem.
Should there be a law preventing a shutdown, and should we expect any type of reform on that front?
Yeah, that is a very good question. Obviously, it seems like there should be, but of course, the body to pass such a law would be Congress, and we're seeing that, Congress is not, let's just say, at its orderly best right now, and does, the other issue here is this hard right faction. They come overwhelmingly from deep red districts where they don't suffer sort of accountability for, what are nihilistic actions to prevent the government from functioning because they just don't like government. And they also aren't really incentivized to govern. They're incentivized by, social media clicks and virality and, getting incendiary speeches repurposed through the social media ecosystem. None of that is the business of the people. And it's a perverse incentive, but it's pretty much locked in for this hardcore group of hard right representatives.
Yeah, and Chris, is this an issue that we're going to see remain here when we talk about the far right, the division within the GOP party? Is that something that's likely to stay now for at least the foreseeable future, given the fact that we have seen efforts in the Senate and in the House to try and unite the party overall, yet it hasn't worked?
Yeah, and again, it's important to roll the tape back to last January when McCarthy went through that marathon, 15-vote process to get the speakership. He gave away key committee chairmanships and rules concessions, including this motion to vacate provision, to this hard right. He empowered this faction, which is indeed, not a significant numerical faction, but because of the narrow House majority that McCarthy has, they have the ability to make or break any given bill. So yeah, it's going to be, this is just one painful and, high stakes illustration of what is a Republican Party that no longer really functions as a political party. I interviewed Norm Ornstein, who's one of the most preeminent scholars in Congress, and he said the Republican Party is now a cult, and it's not governable. And we're seeing that kind of analysis play out in real time over this budget crisis.
Yeah, certainly. All right. Well, Chris Lehman, we've got to leave it there. The nation's D.C. bureau chief. Thanks so much for making the time.
Thank you for having me. Take care.
The government's risk of shutting down if lawmakers fail to reach a spending deal before the deadline. And if we do, in fact, see a shutdown, small businesses could be at risk. There's a recent survey out from Goldman Sachs that found that 70% of small business owners warned that their businesses would be negatively impacted with revenue, a top concern. Here to talk about that and more, we want to bring in Isabella Casillas Guzman, administrator of the U.S. Small Business Administration. Administrator Guzman, it's great to have you here. Thanks for joining.
Thank you for having me. Great to be here.
So when we talk about the threat of a government shutdown, what exactly that is going to mean for small businesses, give us a better sense of that risk.
Yeah, well, Republican shutdown is definitely going to have serious consequences for our economy, and it will hurt small businesses. For example, at the SBA, it'll halt all of our SBA guaranteed small business loans. We put out about $40 billion a year to help support small businesses with affordable capital. And in an environment with there's tight credit and higher interest rates, SBA-backed loans are highly critical today. And each day of the shutdown, there'll be hundreds of loans that would be stuck, unable to move forward. That might mean a small business has to go to a high-interest bridge loan and pay, fees that are exorbitant for their business to manage, and they might lose a deal or lose an ability to buy some equipment or buy property, and that's what's going to hurt businesses, and the uncertainty of it all as well.
Administrator, what type of small business funding have you also been trying to put forward as part of the budgeting process?
Well, we've obviously tried to continue to build up all of our CREATE programs. We help small businesses grow their revenues as well as provide that affordable capital through investments and small business loans. And in particular, when we talk about revenue growth opportunities, this is a historic time when we're investing in America. There are contracts to win around the country. One of the things that would also be halted in the Republican shutdown would be the processing of certifications to do government contracting for our veteran-owned small businesses and service-disabled veteran small businesses and women and others. And that limits competition in the federal marketplace and really prevents businesses from moving forward with their revenue growth strategies. And we need all of our small businesses to be successful. We have an incredible footprint on the ground, network of over 1,600 centers. While each of those are independent nonprofits that we provide grants to, we can't provide oversight and customer service for them to continue their good work. So we know that there's going to be devastating impact, and we continue, of course, to put forward in the president's budget a plan that will continue to grow our great capital programs as well as our networks and support to small businesses.
Administrator, I'm curious to get your perspective on this, just in terms of the general sense, the sentiment right now of small business owners, given the fact that this is just, when we talk about the government shutdown, this is just the latest in a long list of uncertainties that many of these small business owners have been facing now for quite some time.
That's right. I mean, uncertainty is what any small business owner will tell you is disruptive. You can't plan around that. And they're problem solvers themselves. They have a lot of grit and determination to be resilient, but they want to solve problems. And this is a problem that they want to see solved because obviously it could have an impact on their business and their ability to respond quickly in the marketplace. And a lot of these businesses are already straddled with debt, already straddled with having to have reduced revenues during the pandemic. They're starting to see the light and starting to see recovery and want to be able to persist on a very strong plan for growth. Any disruption at any time for them in the next few months is not going to be helpful to their businesses. And so that's why this Republican shutdown is even more detrimental to our small businesses, because there's no time for further disruption when pandemic disrupted their lives so much.
And it seems like from that perspective, small businesses can't catch a break. Where you think back all the way to the pandemic, or if you fast forward to this year and the number of different union negotiations that have taken place and strikes that have also meant that some of those small businesses don't have the same amount of paying customers that are coming through. And for now, as they're staring down a potential government shutdown where that funding could go in a different direction or just not be able to be dispersed to them. So where ultimately are we able to see a clear light at the end of the tunnel for these issues to be surpassed for small businesses, and then for a clear runway for growth of small business in the U.S., especially as we look towards 2024 and hopefully many of these issues being in the rearview mirror?
Yeah, well, just recently, the Chamber of Commerce had done their optimism study, and it was hopeful for small businesses. And as I said, many of them are benefiting from not only the COVID relief that helped position them and help them survive during the pandemic, but they're going after investments in America, whether that's contracts and helping us build our roads and bridges, or whether they're manufacturers or an innovation economy and are planning for the future. They have strong hopes in the future, and that's what's so amazing about our entrepreneurs in this country. And we've seen 13.6 million new business applications filed. These are businesses that we want to see survive. They're the job creators. They're the ones who are going to create the products and services for the future that'll make our economy globally competitive. And so as we look to continue to try to build resilience within our small businesses, they've had to, as you can imagine, plan for so much disruption. They've obviously had to be more agile, more efficient in their operations. But again, there's only so much that they can sustain. And further disruption when it's unnecessary, when we could actually see that this disruption, this shutdown could affect them, but it could be solved. The Republicans could take action. This is something that is very alarming to our small businesses who don't want to see disruption when there could be problem solving instead.
Administrator Guzman, just lastly, while we have you here, the FTC has sued Amazon for illegally maintaining monopoly power, the allegation that's come forward. We no doubt have heard many small businesses talk about the practices of Amazon over the years, but do small businesses want a breakup of Amazon?
Yeah, it's a complicated issue for sure, because we saw, especially during the pandemic, small businesses depending on digital technologies, on key platforms to be able to build revenue and get their products out the door when oftentimes retail and main streets were negatively affected. Being online also means opening up to marketplaces abroad. And on a lot of these platforms, you see small businesses trading with multiple countries and really building their businesses. So it's a challenging topic. Obviously, small businesses want to increasingly leverage digital e-commerce and take advantage of the more than $5 trillion digital e-commerce marketplace that is global. So, I know that small businesses want to continue to have options to move forward. Clearly, the FTC is moving forward with, investigating, making sure that there's no price gouging happening. But we of course want to see small businesses continue to go digital, whatever that platform or however they're able to most successfully do it. And we've stood up a platform for them to be able to find out about all the digital tools that are available to grow their businesses.
Administrator Guzman, it's been great to speak with you. Thanks so much for joining us here on Yahoo Finance this morning. Isabella Casillas Guzman, Administrator of the U.S. Small Business Administration.
Thank you for having me.
Well, we got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah, well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Nutanix shares are on the move this morning. You're seeing them move higher by about 4% after the cloud company gave investors something to smile about, expecting annual recurring revenue growth of 20% by 2027 and projected profitability ahead of prior targets. For more on this, we're joined by Rajiv Ramaswamy, who is the Nutanix CEO. Thanks so much for taking the time here with us today.
Great to be here live with you guys, Brad and Shauna. I've done a lot remotely, and it's great to be here live in the studio. So
live in living color here in Times Square, for sure here. We got to talk about what you guys unveiled and talked about at Investor Day yesterday, and really the street latching onto this updated guidance. What propelled you guys to really, and led you guys to bring that type of guidance out to investors and the confidence that went into that as well?
So just to quickly recap the financial model that we talked about, the medium-term financial model over the next 3 years, we said we were driving to be a $3 billion ARR company, subscription company, software company at scale, driving 20% approximately CAGR for ARR growth between now and then, and driving $800 million roughly of free cash flow. So driving strong, durable growth while increasing profitability. And that is, of course, well received by investors. But let me talk about the drivers behind that. So fundamentally, we've done a lot of work over the last few years to go through our subscription transformation, and we are largely done with that and now scaling. And as you look at what that is, we are also exposed to some key trends in the market. Companies are now running apps and data everywhere. It's not just one location, not just public cloud, not just data centers. And we are the best platform to enable that to happen. So that's a good long-term trend here that we are benefiting from in terms of being the platform for companies doing that. There's also a few other things happening in the marketplace. We've all talked about AI, and that's a good long-term driver. As companies build more AI applications, we can help them run those AI applications wherever they'd like to run, right?
Yeah, how much of a driver is that for you?
It's a long-term driver. People are just getting started now with Gen AI. We've had some legacy AI applications running on our platform for a while, but Gen AI is a whole new thing, and people are experimenting. And I think we'll go from experimenting to real production probably over the next few years. A couple of other trends quickly. Our largest competitor is being bought, and we are the most viable, easiest, simplest alternative to them. And of course, we just announced some new partnerships. I'm excited about the one that we just announced with Cisco, where they are focused on selling our products and no longer selling their own.
Yeah, investors excited about that too. I mean, we saw that come out in one of the analyst notes early this morning. That was cited. Also cited was expense controls for the company, no expiry buyback plan, tucked in acquisitions. So all of these things considered, investors might be right to think to themselves right now, okay, so what the heck is hybrid multi-cloud, and why should we still care about that within our portfolio?
Great question. So it fundamentally comes down to what companies are doing. They're going digital, and when they go digital, the lifeblood is all about applications and the data that they consume. And everybody, you guys are a tech company, right, doing broadcasting, and every company is becoming a software company, and it's all about the app. And they need a platform to run these apps, and they're going to run everywhere. Some of them are going to be in public cloud, some of them are going to be in data centers, some of them are going to be running in factory edges and retail stores. And they need a platform. This is what we call hybrid cloud or hybrid multi-cloud, which is these apps and data are everywhere, and they need a platform to run these apps on. And that is precisely what we do.
And the partnership that you have with Cisco, going back to what you just said a moment ago and focusing a little bit more on that, just how is that taking shape? I know you just announced it about a month ago, but what does this also tell investors and tell Wall Street just about the direction of Nutanix and where you see the company in 3 to 5 years from now?
Yeah, I mean, we see the company as an at-scale subscription company, but truly with a broad ecosystem of partners. And that's really how we go to market, that's how we partner, that's how we meet customer demand. At the end of the day, customers are looking for a complete solution. Now, if you look at the Cisco piece in particular, it's great for customers because they trust Cisco. And here we have a highly integrated solution that delivers everything in one place, right? Delivered by Cisco, a vendor they trust. It's great for Cisco because they're now selling our market-leading solution in the marketplace. It's great for us because it expands our routes to market. We're excited about it.
You said AI is huge for you. When do you see that delivering significantly for your bottom line?
Yeah, I think that's going to be a long-term trend here, right? We just introduced our AI solution literally a couple of months ago here. And customers, like I said, companies are still trying to figure out how to get these AI applications. There's a lot of buzz right now about AI, large language models being trained in the public cloud. At the end of the day, just like with everything else, people are going to have to realize good ROI, TCO benefits with AI, right? It has to count. And so investments have to provide return. And we're going to see the same thing happen with AI as well over the next few years as real commercial applications get deployed.
I'm curious, as someone within this space, obviously, and you've had exposure now to AI for quite some time, what do you make of all the hype all of a sudden around AI and what we've seen surrounding generative AI and how many investors, how many companies are now even just mentioning AI in their earnings calls?
Yeah, I mean, I think it's just
this is good news for you.
It's good for us. From our perspective, we look at it as, hey, here's a whole new set of applications that companies are going to build that use AI. And guess where they would run? Well, we'd love for them to run on our platform, and we are a good platform to run those. So that's how we look at it. But clearly, again, there is a cycle here, right? There's a lot of interest, there's a lot of buzz, there's a lot of experimentation going on now. And then over time, that's going to translate to real business being delivered, with real results being delivered. And that's when it becomes a sustainable thing. And I do think it's going to be a sustainable long-term play for many companies.
Just lastly, while we have you here, Nutanix shares are up 16% over the past month. It's been a tough month for some of the tech stocks out there, as we're taking a look at the Nasdaq Composite, down over the past month by about 4%. So you think about what this has meant for you, the announcement with Cisco, the partnerships, you were mentioning Micron even before we came on here. How significant is this in terms of the not just annual recurring revenue that you're expecting, but the growth perspective for a company like Nutanix?
Yeah, I truly believe this is our time as a company. You know, we've done all the hard work, and now we're starting to see the fruits of everything we did over the last few years here in terms of building a long-term company at scale, sustainably growing, $3 billion plus of ARR in 3 years from now, highly profitable in that time period, meeting the needs of critical needs of customers who are looking to run apps and data. So we're excited about our long-term future, and you're seeing that reflected in some of our stock over the last month.
G. Ramaswamy, great to have you. Thanks so much for hopping on here with us in person at the Nasdaq, CEO of Nutanix. Thanks again.
Thank you very much.
All right, keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. A leadership shakeup coming from Peloton, the at-home workout brand, announcing that its co-founder and chief product officer, Tom Cortese, is going to be departing from his role after nearly 12 years. Now, he's going to be replaced by former Twitter executive Nick Caldwell. And the significance of this here, Brad, is that Cortese, he was the last co-founder there involved with Peloton in that chief product role there. In terms of what this means for the direction of the company going forward, Tom's saying that this is simply time for the company to kind of take it to in a different direction, not so much a different direction, but really move on here from the co-founder, one of the co-founders, in terms of what the company is doing. We know Peloton has been struggling as of late. In its latest earnings report, their guidance disappointed the street. They're suffering from the slowdown that they've seen now for quite some time in equipment sales. So a new appointment, a new executive among the C-suite. We'll see whether or not that helps Peloton here in terms of their turnaround strategy.
Yeah, really looking for direction here, and especially as you look across some of the partnerships that they've been able to drum up to try and get more retail sales. However, if you're looking at that retail sales data, one of the analysts over at UBS is looking across the negative trend in total interactive visits to the Peloton website in tandem with some of those retail visits. Following positive trends in May and June, you had data from UBS analysts led by Arpine Kokrian saying that August data indicated further weakness, and the analysts are suggesting that promotional activities during slower months ahead of a new app launch are perhaps temporarily inflating metrics in June here. So that all kind of wrapped up within this broader Peloton story here as we've been continuing to watch where the street perhaps is souring even more on this name right now. But shares right now are holding on to at least a slight gain in today's activity, but year to date down by about 40%.
It's certainly been under pressure. And Cortese, I found the quote I was looking for, saying that it's time to move on and create space for new perspectives. So we'll see what that means for the direction of Peloton here going forward. All right, let's do one quick check of the markets before we let you go. Again, pressure across the board in the major averages. You have the Dow off just over 100 points. Rochelle Akufo, Akiko Fujita have you for the next hour. See you tomorrow.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. The FTC is taking on Amazon in a battle that's been a long time coming. How will this battle impact the tech giant? We're going to be discussing ahead.
And a strike no more. Over 11,000 writers can now return to work after the second longest walkout in WGA history. But an actor strike still looms.
And former President Donald Trump heads to Michigan today, skipping the second GOP debate. It comes just one day after President Biden joined the picket lines. What this signals for the upcoming 2024 election.
Well, certainly lots going on, but first let's take a look at how the markets are faring this morning. Relatively flat here. We see the Dow here just barely in negative territory, down about 9 points on the day, trying to come off some of the lows it hadn't seen since March from yesterday. Looking at also the S&P 500 there, just barely in the green, up almost about 2.5 points there. Tech-heavy Nasdaq there, also down just about 5 points there, just fractionally in the red. Let's also check in on the Treasury market. Let's also check in on the Treasury market as well. Looking at the 5-year, the only one in positive territory at the moment, up ever so slightly. Still that 10-year stubbornly above that 4.5% mark there. And also the longest term 30-year yield also down just fractionally as well by about 0.4%.
One of the stocks we're watching this morning, Rochelle, is Amazon. That stock pulling back just slightly, at least early on in the session. This coming as Federal Trade Commission Chair Lina Khan arguing for years that federal regulators need to take on big tech. Now she's taking on the heavyweight Amazon with a sweeping antitrust lawsuit filed yesterday, Rochelle. We've kind of been looking through that lawsuit, but of course the backstory adds intrigue to the case when you consider the current FTC chair, of course, as a law student at Yale, wrote this very extensive article titled Amazon's Antitrust Paradox. Here she is 6 years later bringing forward this case against Amazon. We should mention the lawsuit, this current lawsuit from the FTC specifically argues that Amazon's driving up prices for consumers through anti-competitive behavior. We've talked about these Amazon fees as she sees it, that says third-party sellers are required to pay $1 out of every $2 to Amazon to reach consumers. Now, separately, Lina Khan cites Amazon policy that she argues punishes sellers who lower prices for products on other sites other than Amazon. All of that, she argues, amounts to inflated prices. Now, I've been speaking to legal experts, by the way, Rochelle. I'm going to count our very own Alexis Keenan among them because, you know, there's going to be a lot made about what Lina Khan argued as a law student versus what is being argued now. Now, as a law student, she specifically sort of talked about broadly how current antitrust law that's in place, it isn't well equipped to police big tech giants like Amazon because of the sheer scale they compete on. There is an argument to be made that in the FTC case that was filed, it's much more narrow in its argument, and she goes specifically after pricing.
And it was interesting because a lot of people were wondering if we were going to see the words breakup mentioned there. Instead, the lawsuit mentioned structural relief rather than some of these specific remedies about breaking up Amazon. But I mean, Khan was telling Bloomberg, look, this is about competition here. But she also mentioned that it's about cumulative harm. So it's not just about changing a few tactics. It's some of the things that have structurally been in existence, which is what's leading a lot of people to wonder how much of a breakup we're going to see. But we didn't see her go as aggressively as expected. Business Insider, I think, for their banner went with the wrath of Khan, clearly something that was in the making, as you mentioned there, that she talked about in her thesis. I did think Amazon's response was interesting. They're saying that the lawsuit actually is the antithesis of what antitrust law is supposed to do. David Zapolsky, who's Amazon's general counsel, saying that if the FTC gets its way, the result will be fewer products to choose from, higher prices, slower deliveries for consumers, and reduced options for small businesses. Also calling the lawsuit wrong on the facts and the law, and saying they look forward to making the case in court. Something I did find interesting was that when you think of Andy Jassy, who's now at the head here, obviously executive chair is still Jeff Bezos, but the redacted complaint mentions Bezos 16 times and Andy Jassy twice. So this is something that Jassy inherited, but it was something that they obviously saw coming down the pipeline, Akiko.
Yeah, I mean, that's a good point to make because it isn't just about Amazon over the last few years. It is about Amazon collectively and the strategy they've pushed forward, at least as Lina Khan and the FTC sees it. There's an argument to be made here that Lina Khan is taking more of a pragmatic approach in this particular lawsuit when you compare it to what she was arguing as a lawsuit. Some would say, well, that's partly because of the setbacks that the FTC has suffered recently. You'll recall there was a case that the FTC brought forward to try and block a merger for Meta/Facebook. They didn't necessarily win that case. There's also the Microsoft Activision merger the FTC tried to block. That's still ongoing, but at least in the initial phase, it didn't go the FTC's way. So in many ways, you could argue that's kind of been a lesson, multiple lessons, you could say, for Lina Khan. And that's partly why she's taking a very narrow scope in this particular case against Amazon. Of course, Rochelle, as we've learned, these are cases that take not just months, but years. So, we can't say, well, which side is going to have the stronger argument, at least in the initial phase. But certainly one that's going to be watched very closely, given just the sheer scale that Amazon competes on right now.
Indeed, and when you think of where Amazon started to where it is now, I mean, it's light years apart from that. So it'll be interesting to see how that plays out. Of course, Yahoo Finance will be tracking that closely for all of you as well. Well, shifting gears, there are only 3 days left for Congress to pass a spending bill to keep the government from shutting down. The Senate reached a deal on a stopgap spending bill that, if passed, would keep the government funded until November 17th, while House Speaker McCarthy continues negotiations for his 4 full-year spending bills. The Senate's bill includes more than $6 billion in aid to Ukraine, which McCarthy has spoken out against. Meanwhile, McCarthy finally got the vote to bring his bills to the House floor for a debate. Our next guest has been at the negotiating table in Congress and is here to share his insight. Let's bring in former Senator from North Dakota, Byron Dorgan. Thank you so much for joining us this morning. So, as someone who's been in the room in these sorts of situations, when you look at what some of these GOP holdouts are asking for, how close are they to even averting a government shutdown, or how long do you think this might persist, given how far apart they are?
Well, it doesn't seem to me they're close at all. I mean, we have, particularly in the U.S. House, we've got a few loudmouths that care very much about trying to find a way to shut down the government. I mean, it's very bizarre. There's a kind of a profound ignorance here about what this means to the American people, what it means to good government. And so, in the past, we had a Newt Gingrich shutdown some decades ago, and I was one of the negotiators that was selected to negotiate and went to the White House almost every day during that period. And I can tell you, once the government is shut down, it's very hard to find a way to negotiate and get it back. I mean, ultimately it'll happen, but this is not a good thing for the American people to watch. The Speaker does not control the House of Representatives any longer. And the Senate, it looks like it has done something that if they send it to the House and the House would pass it, would give us another 4 or 5 weeks, but then we'd be right back into it again. So my wish is that Congress would begin to behave in a way that it used to behave, do the right thing, compromise. The lubrication of democracy has always been compromise. That's what they should do.
Byron, I wonder if you can speak to that. As somebody who has been at the negotiating table before with that clock ticking on a government shutdown, how is this current political environment different? And how much optimism do you put, given that we could, in fact, avert a shutdown?
Well, the current political system is different than anything I've ever known. And it has to do with Donald Trump. It has to do with a lot of things. It has to do with more tribal politics, people more caring about the political party they belong to than the question of the larger government issues. I really wish that we would see, both in the House and the U.S. Senate, people care a great deal more about good government than their political party. But that has not been the case. And my best guess is, and I don't know this for sure, but my best guess is it appears at the end of this week, we'll have another government shutdown. And the American people do not respect that which brings the government down. They respect smart and good men and women in the Congress who would work together and find the right kind of compromises to move forward.
And Byron, we know in these situations there always does tend to be the blame game. We saw Speaker McCarthy said that a government shutdown would not be on House Republicans, but there was a Morning Consult poll of voters. 34% of them said Republicans in Congress would be mostly to blame for a government shutdown. 23% would blame President Biden. 21% would blame Democrats in Congress. So it seems, at least for the voting public, there'll be enough blame to go around. What is the incentive then for some of these GOP holdouts to keep this up?
Well, there are no winners with respect to the shutdown of a government at all. And, you know, there will be blame cast all around. But there are some people who have come to the Congress who have said, you know what, we don't like what's going on, and we're willing to shut the government down if necessary. And so some have boasted about being willing to do that. I think that's nothing to boast about. The American people deserve much, much better than they're getting, and particularly from the U.S. House. And I mentioned I shouldn't probably use the term loudmouth, but there are a few loudmouths in the U.S. House these days that are very different than the ones that I and many others have served with over decades.
This naturally begs the question, you know, why are we back here where we are? We were talking yesterday about just how many government shutdowns there have been. There is some movement within Congress to potentially sort of change that. You know, one bill that's being introduced here automatically provides continued appropriations if spending bills don't get enacted. There are a number of others that have been introduced as well. I mean, is it time to seriously consider something along those lines so that we're not back here a few months from now, a year from now?
Well, much of this is about spending, as you know, and so we'll see. I mean, there has to be appropriations bills passed in both the House and the Senate and signed by the president. That represents the process by which the government has the funds to do what it needs to do. So we'll see. But I just, you know, again, there are people in the U.S. House. There's about 3 dozen of them in the Freedom Caucus, maybe 4, who don't mind at all if there's a shutdown. They think it makes their case, whatever their case is these days. And I think the American people really have lost a great deal of respect for the politics of the Congress, and especially the politics in the U.S. House. The Speaker does not control the House these days. You remember he had, I think, 15 votes to become Speaker. So, you know, he has a difficult situation as well, but he's making it more difficult by the kinds of things he's doing and by the leadership he's portrayed.
And Byron, I do want to ask you, when you were negotiating, that was a 3-week shutdown. You were negotiating with then Speaker Newt Gingrich during the Clinton administration. Now, that was a 3-week shutdown. Given how much the economy has changed, what sort of repercussions can we expect when we try and get something back up and running when you have an economy as complex as this and as fast moving as this?
Well, that was a 3-week shutdown, and we spent a great deal of time trying to think through and work through how do you put this back up. But this, you know, this is a complicated system that we have these days. Things have become even more complicated, and my best hope is that if there is a shutdown, that it can be relatively brief. But I wouldn't expect that to be the case, given the fact that there's a completely different kind of politics in the U.S. House and in the U.S. Senate. The Senate is different these days. You've seen Mitch McConnell and Chuck Schumer come together. Republicans and Democrats in the Senate come together, at least in this circumstance, for I think a 5-week extension of a continuing resolution. So the Senate is behaving in a way that it should behave just to try to get this done. The House is not doing that. And that has to do with the fact that there's precious little leadership there. And I wish that were not the case, but it is. And I worry very much that if this shutdown exists, that we're going to be in a situation that's going to take a great deal of time to try to work through and find the compromises necessary to put it back up.
Well, the clock's certainly ticking. We've got that shutdown watch on our screen there with just 3 days to go until that deadline. Former Senator Byron Dorgan, it's good to talk to you today. Appreciate the time.
Thanks a lot. Nice to visit.
We are watching shares of Costco rising now after initially falling in extended trading. The company beat expectations in its fourth quarter earnings report and reiterated plans to expand its footprint. CFO Richard Galanti saying in the company's earnings call that over the next 10 years, they could easily add another 150 locations in the U.S. alone. Costco certainly moving aggressively there to expand on that front. Rochelle, you know, in many ways we look to see Costco as sort of a bellwether about where consumers are. We have seen consumers increasingly seek out value. Costco competing on that level. But we also heard from the company yesterday talking about how while consumers are coming through, the amount they're paying in terms of visits or the amount purchased per visit is declining slightly. And also they are seeing a pullback, like many other retailers, on discretionary spending.
And I think it's interesting that when you think of Costco, you already have a higher barrier to entry if you're a consumer. I mean, you're already paying a membership fee for, any other sort of grocery store. You don't have to do that. So you already have that hurdle. And we did actually see the stock price decline at first when Costco said they're not going to be increasing that membership fee. But investors still holding on to that hope that at some point they'll also see that membership fee increase as well. I mean, and when you think of the expansion and where consumers are at the moment, trying to pinch pennies, but Costco still aggressively going ahead. I mean, it really shows that they do have some faith in the consumer, especially as they expand overseas. I remember when Costco didn't exist in the UK and they literally came in like gangbusters and literally became the talk of the town and really outpaced a lot of these big box retailers there. So it'll be interesting to see just how successful Costco can be as we are still in a very high inflationary environment.
I am a loyal Costco card member, I should say.
See, and I am too, but I gotta say, it's for a few things that I go for. Like, I mean, I don't always need a canoe when I'm going to Costco.
Well, also, we all don't have a fridge that can fit everything, right? That's in bulk. That's the biggest problem for me. I just can't buy everything because I don't have a place that's big enough.
You got to be choosy when it comes to your Costco shopping. But we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Well, Hollywood writers are dropping their posters and megaphones, picking up their pens again. Even on Tuesday evening, the WGA and Hollywood studios reached a tentative agreement. So will there be a immediate pickup in day and nighttime television? Rochelle, I can tell you this deal is certainly a welcome sign, at least here in California, where so many people have been off the job for the last 5 months. But the reality is there are still additional hurdles that need to happen in order for scripted content to resume. Number one, this deal still needs to be ratified by WGA members. The Guild has said they're very confident members will sign on for that. But at the end of the day, you've got to have actors in place to be able to start production. And SAG-AFTRA still doesn't have a specific date to meet the AMPTP at the table. That negotiation still undecided.
It's true. I mean, and when you look at what the Writers Guild was able to get in terms of some of these things that in this deal, higher pay, streaming bonuses, more agreements on minimum staffing, and of course, really future-proofing their industry as well when it comes to AI. So it gives us a window into what to expect with SAG-AFTRA. But something else that I was looking at was, we forget that a lot of these actors and these voice actors are also SAG-AFTRA members, and they're in video games as well. So you also had a vote there to go on strike for a lot of these video gamers who are saying, look, my voice, my data is being used in this as well. We haven't had, in some cases, pay rises in 4, 5, 6 years. So they're also joining the fray. So as we're getting some relief at one end, some more things bubbling up as well, as this really does speak to how much the media landscape has changed, thanks to things like streaming and AI and new tech giants coming into the space as well, Akiko.
Yeah, I mean, Rochelle, you used the word future-proofing. It really was about that, at least in this particular round of negotiations. We're talking about protections against artificial intelligence. In the case of actors, it is about from AI images. But in the case of writers, it was about content generated by AI. In terms of that bonus that was tied to streaming views, that's a pretty significant win for the WGA, because they have argued that in past negotiations, they had sort of seen the writing on the wall that things were headed in that direction, but they did not receive compensation. The studios didn't necessarily want to share that information in terms of views there. So there seems to be have been a bit of a compromise there. The WGA now has a deal in hand. The question is going to be how much of that will mirror what SAG-AFTRA gets in hand. And the hope here is that they can come to a pretty quick resolution with the studios so that production can finally resume after 5 months on hold.
It's true. I mean, they do have some overlapping issues when it comes to the writers and the actors, but actors have also a whole different set of considerations when it comes to their image and how that's used in AI. So it'll be interesting to see how they address that. And when we look at some of the appropriate costs, we're looking at here, some of what the strikes have cost the economy, an estimated more than $5 billion here. When you think of not just salaries, but catering, the local industries that they support at hotels when they go and shoot in different places. So definitely an impetus, because it did seem at first that the studios, not that they weren't negotiating in good faith, but really didn't seem to be as vocal as they had been. I think they saw a bit of pushback there when they saw people continuing to support some of these unions.
Yeah, that number put out by Kevin Clouden over at Milken Institute really points to the impact, as we noted there, not just in California, but broadly. He's made it very clear that this particular strike was a little different in terms of how the impact rippled across the economy, because Hollywood has diversified. It's not just production in California, it's production in Georgia, it's production in the UK. Things are a lot more distributed right now, and that's why we have seen that impact even higher. I mean, $5 billion over the period of 5 months. Certainly going to sting in the expectation here, at least, not just with content, but the ripple effect. Things aren't going to bounce back immediately because it's going to take a while for everybody to get back to work.
Indeed. All right, well, shifting gears now. According to data from BlackRock, some yields are seeing levels that they haven't seen since the financial crisis, and the aggressive rate hikes set by the Federal Reserve have unlocked a new generational opportunity. Now, this includes in yields and in the bond ETF space. Our next guest is finding that there is growing adoption of bond ETFs in the current market climate. As part of our ETF report brought to you by Invesco QQQ, let's bring in BlackRock Global Co-Head of iShares Fixed Income ETFs, Steve Lapley, to discuss more. Thank you for joining us this morning, Steve. So I want to first talk about this generational opportunity, considering where we were during the financial crisis, and really how much more upside you see ahead.
Well, it is pretty remarkable to think back over the last 10, 15 years. If you look at where we were on 10 years during 2020 compared to now. We were below 50 basis points. Now we're above 450 basis points. So that is a massive shift. The front end of the curve even more so with the Federal Reserve tightening policy aggressively here. So what that means is that investors are able to completely retool their portfolios in ways that simply weren't available before. We've been able to look at taking risk off the table with equities and adding back in fixed income risk, which if you go back even 3 or 4 years, you can get more at the front end of the Treasury curve than you could in high yield at the end of 2020. So that's quite remarkable, and it just provides investors with degrees of freedom that they didn't have before.
Yeah, it does feel like bonds are back in fashion, right? Which is sort of kind of a funny thing to say here. But given the yields that we have seen, to your point, sort of on the short end as well as on the 10-year, we've seen a lot more interest move in that direction. Is your expectation that these yields will remain pretty elevated for longer?
Well, that's what the Fed is telling us, and they keep reinforcing that message over and over, and they've been very aggressive about reinforcing it. So I think that, the data is supporting them up to this point. We've had stronger data than expected. There's a lot of discussion about the dot plots moving up, but, there's also discussion about the role that the deficit's playing here, and then investors reassessing the overall term premium in the market for longer term bonds because of the deficit. So there's a lot of cross currents going on here, but I do think we are unlikely to go back to the levels that we saw a few years ago. Now there will be give and take, especially if we have a slowdown in the economy. You could see a retracement at the long end of the curve, which I think that speaks to some of the flows we're seeing, despite the backup in yields, especially at the long end that we've seen recently. We still continue to get flows in the longer end of the Treasury curve. So TLT, our 20-plus Treasury fund, is still sort of the king of flows this year at 16 billion. We've taken in 40 billion overall into Treasuries, and that's spread pretty much around the curve. But it is interesting to see those flows still coming into the long end of the curve.
And when you look at the makeup of who's investing here, what are you seeing in terms of institutional investors versus retail investors?
It's a healthy mix of both. I do think that there was quite a sea change during the COVID volatility, the worst of it during February and March of 2020. We saw institutional investors who, had been using bond ETFs to a limited degree, but I think during that period of volatility when even treasuries were dislocated, we saw quite a lot of assets come off the sidelines from institutional investors into bond ETFs. Simply out of necessity. They were managing risk, navigating that market. When the market pivoted back to risk on, it was much easier to leg back into the market through bond ETFs than it was the underlying. Just like it was much easier to sell when things were risk off at the beginning of the onset of COVID. So I think now, as we stand here today, we have I think 9 of the 10 largest global asset managers are now users of bond ETFs. Something like 6 or 7 of the largest insurance companies now use bond ETFs. So it's been quite a sea change of adoption over the last few years. Retail investors continue to discover, I think the power of this tool in leveling the playing field for bonds. It's much easier for them to access bonds with bond ETFs than it is individual bonds, and they continue to allocate based on that.
So how do you think investors should be putting their money in the space, money to use in this space? I mean, what are you advising your clients in this environment?
Yeah, and this gets down to investor preference, as you might imagine. So, right now, I do think that we, prefer to stay sort of short and intermediate in high quality fixed income. That being said, it is very, very hard to time the top end rates. And so what we have seen investors do, again, just by virtue of the flows into something like TLT, investors are layering in longer term bonds, almost as an insurance policy, if you will, against, a potential slowdown in the economy. That's been talked about for months and months. We'll see if and when it arrives, but we have seen investors sort of moving out on the longer end of the curve. The value is at the front end, but we've seen that healthy mix. I do think we prefer higher quality. It is tricky in high yield right now. with the slowdown being talked about, it's very tough to call a credit cycle if and when it does happen. So we like higher quality, staying sort of short, intermediate on the curve.
I appreciate you joining us this morning with your insights. A big thank you there to BlackRock Global Co-Head of iShares Fixed Income ETFs, Steve Lapley. Thank you so much.
Thanks so much.
Well, let's do a check of the markets sponsored by Tasty Trade. Looking at a mixed picture here, we see the S&P and the Nasdaq currently at session highs. The Dow still under pressure, but at least some of that selling action has slowed down about 50 points so far. The S&P 500 up just fractionally there, almost about 1.5 points. And the tech-heavy Nasdaq there, strongest gainer so far this morning, up about 27 points on the day. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Historically, Democrats have relied on union support to help drive their campaigns, but could the UAW strike change that? Former President Trump heads to Michigan today to speak with striking car workers, auto workers, and it is expected to slam Biden's push towards electric vehicles. In a previous post on his social site, Truth Social, Trump called EVs a, quote, disaster for both auto workers and consumers.
Now, of course, Michigan is a key battleground state in the 2024 presidential election. And though union leadership hasn't made their official endorsement, polling suggests Trump could be gaining favor among auto workers. A survey from research firm Epic MRA found in June that 51% of union members favored Biden compared to 42% favoring Trump. Now, that divide actually flipped in August, with Trump sitting at 46% favorability compared to 43% for Biden. Now, union leadership has publicly spoken out against Trump, with President Fain refusing to meet with the former president later today. Fain telling CNN Trump serves a, quote, billionaire class and doesn't care what striking workers stand for. Well, joining us now is Marek Masters, business professor at Wayne State University's Mike Ilitch School of Business. Thank you for joining us this morning here. So obviously you have Biden, who visited yesterday. You have former President Trump visiting today in a battleground state of Michigan here. What is at stake here in terms of how this strike is being viewed?
Well, I think it's being divided along partisan lines. They appeal to different constituencies in part, but in whole, both Trump and Biden are appealing to the auto worker writ large. And that includes workers who depend not only on the original manufacturers like Ford and General Motors, but also on the suppliers. It's important to remember Trump is coming to speak at a supplier. There are about 6,000 suppliers that employ 660,000 jobs. Many of them have already had to lay off employees as a result of the strike. They're concerned about what might result from not only a strike, but the bargain that's struck ultimately between the auto workers and the parties, and the extent to which that might affect them and the survivability of the auto companies.
There's certainly been a lot made about the number of labor strikes that we have seen over the course of the summer alone. And yet when you look at the overall labor force, the workforce, just 10% is organized. So how important is a political backing and endorsement from unions in a presidential election?
Well, I would say it's certainly less important than it was if you go back to 1968, when the UAW put a lot of effort in trying to elect Hubert Humphrey president, when in fact a substantial number of the UAW members supported George Wallace. I think you're in the same kind of situation now. The auto workers have never been of a single mind when it comes to politics. There's always been division, and there is a sizable conservative or populist wing in the auto worker membership. And Trump appealed to that in 2016. Perhaps somewhat less so in 2020, but he's here to broaden that appeal, and he's going to appeal directly over Sean Fain's head. He has no interest in talking to Sean Fain. He wants to talk to the membership, and he knows that there are a lot of people that work in the auto industry that are employed by non-union employers, and he's concerned about the exodus of jobs and the fact that America is behind in the electric vehicle manufacturing gains, so to speak, and that if we don't do something to catch up quickly, we're going to lose the industry.
So then how do you see them really balancing this issue when it comes to EVs? Obviously, this is where the future is heading. And you have President Biden pushing for his Green New Deal, wants more investment here. But then you also have some disgruntled, workers who are saying, look, what does this mean for our jobs? You have AI, you have a lot more automation coming in with the new batteries and things that come with this. What is the smart play here? Because you want to appease the unions. You have a sitting president here joining on the picket line, but also trying to push this EV future as well.
Well, I think it depends on your perspective. From Trump's point of view and from his constituents' point of view, the smart play is to put the brakes on Biden's policy. From Biden supporters, the environmentalists, they want to continue those policies. The union members are sort of caught in between. They're not against electrical vehicles per se, but there is a fraction of them, some percentage of them, that don't like it being mandated by various government policies. And also there are concerns that they have about losing jobs because it takes fewer workers to produce EVs. And most of the jobs that are in the manufacturing of EVs and batteries are non-union.
I mean, that's I guess the question about what this all means for the big three U.S. car makers. I mean, this is a global competition, a transition that is happening not just in the U.S., globally. And you just made the point. You've got the Midwest here unionized, but when you look at the expansion that is happening in Georgia, the expansion that's happening in South Carolina, those car companies, the foreign car companies, aren't tied to unions.
That's right, and neither is Tesla. Elon Musk said today that he thought that if the auto companies, the Detroit Three, acceded to the union's demands, they were going to bankrupt themselves. And he will be there to pick up the pieces.
And so there is that question of who's winning, as depending on whether or not the union gets all its demands met. If the big three does have to shell out more money for compensation as well as some of these other benefits as well, is it really going to be a Tesla as well, or perhaps could rumbling start there, or perhaps is it foreign automakers who aren't subject to these same union pushes?
Well, I think that competition is going to take advantage of the situation keenly. It always has. And to a certain extent, the auto companies have priced themselves out of business. And that's not due strictly to labor. It's due to a variety of other factors, including I think they haven't been particularly prescient or foresightful in their competitive strategies. But at the same time, anything that you add to the bottom line, you either erode profits, or you have to increase productivity, or you have to cut costs someplace else. And it's going to be difficult for them to increase productivity, particularly given that the auto workers want a shorter work week and they want more time off.
Merrick Masters, business professor at Wayne State University's Mike Ilitch School of Business. It's good to get your perspective today. I appreciate the time.
Thank you for having me. I appreciate it.
Well, it is time now for today's chart of the day. And today we're asking the question, is the IPO market back? Well, Wall Street certainly has reason to be optimistic. Companies listed on U.S. exchanges raised roughly $7.2 billion so far in September, according to data compiled by Bloomberg. ARM's mega debut accounts for nearly $4 of every $10 raised in the month, but a boost worldwide hints at better conditions for the public offering market. That's all assuming central banks don't spoil the run. Rainmaker Securities Managing Director Greg Martin says that if rates remain stable in 2023, the year could see a solid IPO market established, and 2024 could open the floodgates. Rochelle, you could argue that we've certainly had a good run in the month, but what's interesting to me is that what we have been hearing in terms of this enthusiasm in the public markets doesn't necessarily jive with what we've heard from, for example, VC-backed companies or VCs themselves, who are saying, look, yes, some of these companies, especially those that have high valuations, want to test the markets. They don't necessarily have the balance sheets in place right now for where the market wants it to be. It's increasingly about profitability, not just about growth. And so you've got to have, there's a bit of a mismatch that's happening. You could argue that maybe more and more companies are going to start to line up, but the same companies are looking at what happened with Instacart, $39 billion valuation in the private round, a much lower valuation in the public markets.
It's true, and you raise a good point, because all IPOs are not created equally. And you mentioned Instacart there. It already has immense competition from the Uber Eats and the DoorDashes of the world, whereas ARM is positioned differently. And when you think of even Birkenstock coming to market as well, these are established brands that perhaps have really carved out their own lane. Instacart, really not as lucky in that regard, didn't have that much of a moat around it. So it'll be interesting to see which ones really pull ahead, which ones have the staying power. ARM, of course, pulling much further ahead. But when you look at Instacart, I don't think they had enough of a moat to really sustain some of this momentum. So hard to really gauge at this point whether, IPOs are back in full form at the moment.
Yeah, although if you look specifically at Wall Street commentary on ARM, you could argue that there's some that are still very skeptical about their ability to compete beyond their core market, which has been in mobile, and whether in fact they can bring in revenue on the AI side. So still a lot to be watched here. But coming up ahead, we've got much more market action. Stay tuned. You're watching Yahoo Finance Live.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communicopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning, Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
The U.S. Latino economy is growing. According to a new report by Latino Donor Collaborative, the U.S. Latino economy has a $3.2 trillion GDP. Now, when compared on the global stage, the U.S. Latino population comes in fifth behind Japan and Germany. Joining us now with more information is the co-founder of the group behind this project, as well as the Latitude co-founder, Sol Trujillo. We also have Yahoo Finance reporter Danny Romero joining us as well. Big thank you to you both. So I want to first talk about how this was calculated when you think of the US Latino GDP contributions here, and why you think it's so important to focus on this when you look at it in terms of the broader US economy as well, Sol.
Well, first of all, thank you for having me. And let me just say, the reason why we do this is because we want to make sure that we understand where our growth is as a business person. And right now, you know, you're talking about China and the flattening of their growth rates, talking about other pressures across the globe. And then domestically, we have a baby boomer growth cohort that used to be a growth cohort that is now, you know, aging out in a technical sense. And so the question is where's the growth in the US economy coming from? And right now, this study shows, and the reason why I started this study 6 years ago was that we needed to understand there's a cohort in the United States that basically is about 65 million people growing to 100 million people over the next 20, 25 years that is now generating a dramatic portion of our growth. So why is it important? It's important for any business to understand where their growth is coming from and to target consumers and to do it cost effectively and cost efficiently and to service them well. It's important for capitalists, people that have capital that believe in investing where the growth is. And third, if you're a political leader, you should understand the value of the cohorts that either may elect you or not elect you, or people that are going to grow the economy in each of your states or cities or, you know, regions, because the Latino cohort is now, through all the data that's here, it's driving the growth in virtually almost every state, 48 out of the 50 states. So we have a phenomenon that differentiates the United States from Japan, from Europe, and now soon to be China, given the impacts of their slowdown and the ultimate impacts of their single child policies. So we now, the United States, have a growth engine that we can point to we should feed with capital, and we should feed about including them in almost every strategy for every business.
And diving into the report a little bit more, how home ownership rates are very low for Latinos. What's at stake here, knowing that?
Well, home ownership rates have been low historically. One, because it's a youthful cohort when you look at the size. Two, it's growing now faster than virtually every other cohort, where right now it's accounting for over 50% of all new home mortgages taken out. So because it's youthful, and also because of the youth, their income levels are not quite the same. And so now that they're growing and participating in the workforce, you're going to see, and you are seeing for the last 10 years, the Latino cohort essentially accounting for over 50% of all new home mortgages taken out. So it's moving, but the base, because it was so young, and also because there were a lot of immigrants from 20 and 30 years ago in the base, it's now changing dramatically. And that's the good news, because if you're a home builder, if you're D.R. Horton, the biggest home builder in the country, you should know who's about to buy your next home that you build or has bought in the last decade or so.
And to that point, Latino households are growing. What are the factors weighing into that acceleration right now?
Well, the acceleration is essentially youth. So if you look at the Latino cohort, and you were look at the whole age group of 0 to 100, the most populated age for the Latino cohort is 11 years old. If you look at the Anglo-American cohort, the most populated age of 0 to 100 is 58. So if you're anybody that has capital, if you're a business and you think about where your growth is going to come from, it is with this cohort within the United States. And also, if you're a foreign company, if you happen to be Nestle sitting over in Switzerland, who probably generates maybe 40% of their revenues out of the US, maybe 60% of their profits, well, guess what? They better understand who their consumer is today and for the next 3 to 4 decades of growth because of this youthful element. And also the educational attainment that's now being achieved, the matriculation into college and advanced degrees, and the matriculation into, tech, kinds of skills and backgrounds. I mean, it's really changing right before our eyes. And what I want to do with this report is make sure that all Americans see it, because we have hope, we have growth, and all we now need to do is take advantage of it.
I appreciate you joining us, and hopefully investors taking note there of some of the industries that are going to be driven by contributions by the US Latino community. Appreciate you for joining us this morning. Sol Trujillo, Latitude co-founder, and of course our very own Danny Romero. Thank you to you both.
All right. Thank you.
Well, in a new report out today, a string of high-level executives have transferred from ByteDance to TikTok, some even moving from Beijing to the US. That's according to the Wall Street Journal. Now, some executives took top jobs in the app's money-making operations, taking roles overseeing advertising, HR, monetization, marketing, and e-commerce. Now, the moves have made some US-based TikTok employees concerned. They're saying the appointments show that ByteDance plays a greater role in TikTok's operations than the company has previously said. For more on this, Yahoo finance reporter Dan Howley here to break down what this means for the platform. Dan, interesting here considering we already know TikTok and ByteDance have really been in the eye of regulators.
That's right, Michelle. We had the CEO, Chu on Capitol Hill basically talking about how there's a separation between TikTok and ByteDance, and there is some, conversation between the two companies. But he wanted to kind of focus on how TikTok seemingly operates on its own rather than as a direct subsidiary of ByteDance. But clearly, that's not the case. And this is where we're seeing these kind of moves that employees, according to the Wall Street Journal, are concerned about. We've had representatives from different levels of government, whether that's from enforcement organizations or elected officials, talking about the potential for TikTok to be used as a spying tool by the Chinese government. We've talked about how different users could be fed misinformation and disinformation, and about how information from individual users could be collected and then pooled to get a sense of future elected officials or future government workers who then could be influenced based on perhaps what they post on TikTok. Really, a lot of this, though, is still not exactly confirmed by the government. There's discussion of fears, but there's been no evidence brought forward that this is actually happening in any way, shape, or form. But that doesn't mean that we haven't seen any government action on this part. We've seen some states come forward and try to ban the use of the app. The government, U.S. government, currently bans military members from using it on their devices. There's different governments who ban employees from using the app on their devices. Even some universities are banning the use of the app on their Wi-Fi networks. Now, that doesn't necessarily mean that all of these people can't use it on their private devices or they can't use it on their own networks, but it shows that there is obviously some kind of pushback that the government is trying to move against TikTok. This isn't going to help them in the eyes of regulators, in the eyes of enforcement officials. I think it's just going to go against them and kind of help ratchet up the rhetoric on whether or not TikTok should be banned entirely from the U.S. Although we've talked multiple times about how the reality is that's not possible based on First Amendment grounds. It's probably not going to happen anytime soon. The Trump administration had tried to ban it. There was talk from the Biden administration about making similar moves. But right now, this latest kind of update on where the company is and what it's doing, it's just not going to look good for TikTok.
Yeah, we should point out this coming from a Wall Street Journal story, but you're certainly right. This comes at a time when the company is trying to stay out of the crosshairs of government regulators, but a story we'll continue to follow. As always, Yahoo Finance reporter Dan Halley, thanks so much for that. Let's do a final check over the market stand right now. Things appearing a little calmer after that steep sell-off we saw yesterday, but we are seeing the Dow and the Nasdaq trading pretty flat, dipping in the red just slightly. The S&P 500 up just 2 points there. Dow giving up some of the gains that it saw earlier on in the session. We are continuing to watch yields there, talking about levels that we have not seen in 15, 16 years. We've seen it pull back just slightly there, but something we will continue to watch as the Fed remains in focus, a key driver in the market. That does it for us for this 11 o'clock hour. I'm Akiko Fujita along with Rochelle Kupo. We'll see you right back here again tomorrow.